It's something worth celebrating. It's something that makes us stronger as communities, as businesses, and as individuals.
I see the benefits at Bloomberg on a daily basis. It's beyond flying that rainbow flag. It's about taking the discussions out into the world and making a genuine difference.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
It's a great question. Great question. Great question.
Great question.
Great question.
That's going to be the best question I get all night.
I'm glad you asked that.
Bloomberg Television. Top experts. Great questions.
Bloomberg Surveillance. Good morning, everyone. We're waiting on a conversation with our Maria Tadeo, the president of Lithuania. We're moving that in their busy schedule. Maybe in the next 45 minutes, we'll keep you abreast of that. That is a critical conversation given the hydrocarbon turbulence that we see in the European Union. Thank you, Have Blas, which I'm mispronouncing. Lisa made note of that earlier. On radio, it's simple. All you need to know is coal has surged up again off of all these tensions. And Lisa, again, this comes back to ESG out the window. Germany is burning coal.
Well, and they have these triggers now. And if they get below certain reserves of natural gas, they'll go to coal and they'll start using coal more because they want to definitely fuel their economy. And then if that comes down also to levels that are concerning, if reserves get below another certain level, then they start to have a state-controlled decision about where there will be cutbacks to energy usage, including in recreational types of affairs. This is fascinating at a time when every politician wants to avoid these types of wear a sweater proclamations.
Some of the turmoil there, and of course we'll see that in America today with oil and a gallon of gas. I'm going to call it quiescent as well. Lindsay Piegza knows that. She's chief economist at Stifel, joining us this morning. Lindsay, the sensitivity of a gallon of gas, what does it do to your GDP calculation? Is it like tangential, or does it really play into the consumer part, the business part of GDP?
Oh, the easiest way to derail the American consumer is sustained heightened energy costs, which is exactly what we're seeing. So when consumers look at near $5 a gallon in terms of the price of gasoline, this is going to severely retard their ability to spend in other areas across the marketplace. And that's going to have a significant impact on growth, as we're a consumer-based economy. And 70% of that growth comes directly from the consumer's ability to spend on not just non-discretionary goods, but particularly discretionary areas of activity.
Right. Lindsay, Kaylee, Lisa, and I were having a post-show mimosa yesterday, and we were all confused. It's a group effort. We were confused over Chairman Powell saying it's a strong economy, and yet people like you are hysterical about recession. Can you partition it in that the domestic economy, C plus I plus G, is pretty good, and all the angst is about the import-export dynamic X minus M?
I don't think you can argue that it's an isolated component of growth that's slowing. Right now, yes, the Fed chairman was correct. The labor market appears to be solid, but we're already seeing signs of cracking even in the labor market as companies prepare for downturn, and we're seeing layoffs pick up. Now, that's not to say that the economy is going to fall off a cliff, but we are seeing weakness in the consumer. We're seeing a slowdown in manufacturing. The housing market is taking a hard hit. And so Chair Powell seems to be micro-focused on a few statistics in the labor market as justification for this relentless backup in the federal funds rate.
I can't say enough, Lisa, how this harkens back to the conversations of 1994. It's forgotten in the mist of time, but it's a two-part American economy, domestic and foreign. And I'm sorry, the foreign numbers now are all messed up.
Which is possibly the reason why you're hearing some concerns about dollar strength by companies, not because of necessarily the currency, but because of what it represents, which is weakness abroad and a lack of buying power in other non-U.S. nations. Lindsay, when we take a look at just what you're talking about, the economic data rolling over just a touch, how much does this indicate the Fed has an easier path? They won't have to raise rates as much. How much is that the signal, frankly, from the bond market right now that's got some support on all sides of the curve?
Unfortunately, the Fed is not focused on domestic strength or domestic weakness. So even if we see a further faltering in the data, if inflation remains elevated, regardless of what we're seeing in terms of GDP, the Fed has said they will continue to raise rates. In fact, if we look at the latest forecast from the Atlanta Fed's GDP Now model, they suspect that second quarter GDP is going to come in flat. So coupled with the negative print at the start of the year, we're talking about less than 1/10 of a percentage point away from current recessionary conditions, yet the Fed is still considering an additional 75 basis point increase just a few weeks from now. So right now, the Fed is solely focused on inflation, and if we continue to see elevated prices coming down, particularly from the supply side, the Fed is going to tighten not only into recession, but potentially into a deep and dark recession.
Okay, that's where I wanted to go. As we talk about the R word and this idea that Jay Powell put out there, that it might be something that is unavoidable, how much are we looking at a much deeper recession versus a shallower one, especially if it's happening sooner?
Well, again, it's going to depend on whether or not we see price growth slow with domestic growth. The Fed's going to continue to raise the cost of capital, which will tap down consumption, tap down investment, and result in that slower growth profile. But if supply side prices slow with demand, then the Fed is likely to back off sooner than later. And this is where we get a more shallow recessionary scenario, a more run-of-the-mill recession, if you will. However, if growth slows and prices remain elevated, the Fed will continue to tighten, forcing us further into a deep and prolonged recessionary period, potentially leading to a stagflation period, which is certainly more difficult than for the Fed to alleviate with traditional monetary policy metrics.
Okay, so Lindsay, is essentially what you're saying that even if demand does moderate, if it doesn't moderate to the extent that it offsets still constrained supply, then the Fed isn't actually going to be able to achieve its goal of bringing inflation back down to something in the ballpark of 2%.
Absolutely. And so this is the conundrum that the Fed is facing. Yes, we did see some demand side pressures as a result of trillions upon trillions of federal stimulus. And that component can be addressed by raising the federal funds rate, by increasing the cost of capital. But the Fed raising the cost of capital does nothing to address the supply side pressures that we're seeing as a result of the aftermath of COVID-19, or more recently because of international conflict. These are variables outside of the Fed's control, and the Fed chairman has acknowledged as much.
Yeah, he can't print ships, right? And he can't pump more oil. That is outside of the chairman's abilities, as he tried to indicate to lawmakers yesterday on the Hill. We'll see how he fares in day 2 of that today, Lindsay. We've asked this question a few times in a few different ways over recent weeks, but we talk about the goal of getting down to 2%. What is your understanding of how quickly the Fed intends to get there?
I think the Fed has somewhat abandoned the specific 2% range target in lieu of a meaningful decline, a downward trajectory. So the Fed doesn't need inflation to retreat down closer to 2 or 2.5%, but they need to see a steep downward trend well established before they're willing to back off. And we're not talking about 1/10 or 2/10 of a percentage point of improvement, as we've already seen, remember, in the PPI and the headline CPI, but they want to see a marked reduction in prices in order to feel that the trajectory has been well established nearer that 2% target.
Lindsay, my question of the week, we asked this of a gentleman from Deutsche Bank in the hour. Let me ask you as well. The media looks at angst like inflation, and someday it'll be less inflation. And yet, you know, inflation's at the margin, where if we see any tick down in core inflation, expectations in the markets change. Is that the scenario we're going to see?
It could be, but that certainly doesn't represent what we saw in the latest CPI report. Remember, the core CPI actually improved. We saw that second derivative decline in terms of the annual growth rate, and yet market expectations for inflation actually ticked higher because the headline rise was larger than expected.
How critical is tomorrow's UMISH number, 5 to 10s?
Oh, it's very important, because I think that backup in expectations and inflation expectations was one of the primary drivers that drove the Fed to take that more aggressive action in June, ramping up instead from 50 basis points to that 75 basis point increase. The Fed is aware, or was aware, that inflation had not yet peaked. So expectations within Fed policy members for a higher CPI number, I think, was well established. But the market was caught off guard, and with that backup in inflation expectations, expectations, that was enough to force the Fed's hand for a larger policy move in June.
So based on the Fed's expectations for raising rates 50 to 75 basis points on July 27th, what are the odds of a hard versus a softer recession? I don't know if you can even say that, but the idea of a deep one versus a shallow one.
Well, I think right now, when we look at where supply side prices are and the limited improvement that we've seen, restoring balance to the global marketplace, establishing full resolution to international conflict, this seems to be a very complicated process at the very least. And so I do think that the prolonged nature of these factors impacting costs leads us to a higher probability of a hard landing, of a deeper recessionary scenario. So when we're trying to handicap hard versus soft, I would say at this point, 60-40.
Wow.
Thank you, Lindsay. Greatly appreciate it right now. I'm typing in. We're doing work here in the terminal. We all have terminals. Even Kaylee has a terminal that shows something besides crypto. And Lisa, it's real simple. When was the last time we talked about a draw up? We have a NASDAQ draw up right now. It's a draw up of 4.79% off the bottom. Yeah. That's not a drawdown.
What are you talking about? What time period are you talking about?
Like a cup of coffee, cup of tang, you know, we're there.
We're looking right now at a 0.9% gain ahead of the market open, at least according to my terminal.
1 day,
here.
2 day, 3 day, 4 day.
I'd like to remind you that it's still down 28.5% year to date, Tom.
It's a drop.
Yeah, you draw the line up ahead of the open. That seems to be where we are. This could change in a cup of coffee again, Tom. And how much is this really just people trying to find a bottom? If there is some sort of rolling over in the data in a recession, you get the haven bids, the cash flows, yields come down, then you get the tech names actually start to rally again.
And Kaylee, Lisa had to get therapy this week because she went to this grocery store and there's one less tomato in the can of tomatoes. Do you know in Tang, there's like a half an ounce less now?
Is there?
Yeah, in the bottle.
You checked?
I checked.
Did you write a strongly worded letter to the producers of Tang?
He talked to my therapist.
We're going to see this everywhere.
A lot to talk about.
Okay, we got a draw up in the market. Come on, I'm going to get a 28 on VIX, 29.08 on VIX. That's not bad at all.
No.
Futures up 21, Dow futures up 102. John from Europe emailed and said, why are you quoting the Dow? Because we're American, that's what we do. Dow up 108 points, NASDAQ up almost a percentage point. That's actually significant. 2.99 handle in the 2-year yield. Stay with us on foreign exchange. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. Both Republicans and Democrats in Congress are signaling there is little support for President Biden's call to suspend the federal gasoline tax. It's seen as a symbolic move by a president running out of options to ease prices at the pump. The president blames much of the increase on Russia's invasion of Ukraine. Germany has triggered the second stage of its natural gas emergency plan as Russia cuts back supplies. That is European gas prices rising in the so-called alarm phase. Berlin will tighten monitoring of the gas market and reactivate some coal-fired plants. The German government warned this week that there could be further cutbacks in Russian gas. Rescue and relief teams are struggling to reach survivors of a deadly earthquake that hit the remote southeastern region of Afghanistan. At least 1,000 people were killed and hundreds more injured. The Taliban has urged international aid agencies to help. U.S. prosecutors say British socialite Ghislaine Maxwell should spend 30 to 55 years in prison for engaging in a sex trafficking scheme with the late Jeffrey Epstein. A federal judge will sentence Maxwell next week. Prosecutors called Maxwell a sophisticated predator. Bloomberg's learned that Tesla is taking steps to ramp up output at its factory in Shanghai. The electric vehicle maker will partly suspend manufacturing at various points through early August so it can upgrade production lines. The goal is to eventually double its original planned target to 1 million cars a year. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Companies now, they're getting hundreds, maybe even thousands of applications. So software has come in to automate the process.
You want to write your resume for robots, not for humans. The only job your resume has is to be comprehensible to the software that is reading it, because that software or robot is going to decide whether or not a human ever gets their eyes on it.
These things are programmed by a certain segment of the population that might not be totally inclusive or not be fully aware.
Concerns about how this technology could exacerbate discrimination. For the FTC, I think foremost, the FTC needs to be making sure that we're fully understanding this technology.
We don't trust companies to self-regulate when it comes to pollution. We don't trust them to self-regulate when it comes to workplace comp. Why on earth would we trust them to self-regulate AI?
A lot's happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
I think we're now back into a period in which it does matter, where it's the fundamentals of earnings, the fundamentals of margins, the fundamentals of inflation and interest rates, and putting that all together in terms of appropriate valuation models that will make a big difference for investors going forward.
Thank you for the response to our conversation yesterday with Abby Joseph Cohen. She, yes, is a former advisor to Goldman Sachs and now at the Columbia Business School. But I got a heated response from Global Wall Street on her parsing of alpha and beta. That was a very important conversation, a real clinic. Go look for that on Bloomberg Digital. Kaylee Line's in for John Farrow. John Farrow.
Oh, that guy.
That guy. Lisa Bramwitz and Tom Keener. We're waiting for an important conversation with the president of Lithuania, with Maria Tadeo. But right now on the dollar and on foreign exchange, we turn to Thanos Vanvakidis. He's global head of G10 FX Strategy, Bank of America. Thrilled he could be with us this morning. Thanos, let's start with first principles. What's wrong with a strong dollar?
Well, there's nothing wrong about it. It is consistent with the fundamentals. It is overvalued compared to the long-term equilibrium, but the fact is that the Fed is the most hawkish central bank out there. They are dealing with an overheating economy, while other economies are dealing with supply shocks. Also, risk aversion is supporting the dollar. The terms of trade, as the U.S. is energy independent, supporting the dollar. So there are specific reasons why the dollar is strong. And given that the Fed is focused on fighting inflation, a strong dollar is the result.
Thanos, this came up twice yesterday. The Bank of Japan has a policy in place. They haven't blinked. And I hearken back to 1992 and George Soros in the Bank of England. Is there somebody out there in the market overtly trying to do a Soros redux? Or is that just fiction made for Hollywood?
Not necessarily. Actually, investors have missed the yen trade. The Bank of Japan is the only G10 central bank sticking with unconventional loose monetary policies. You can justify this because the core inflation is still well below 2%. And yen has been weakening also because of the deterioration of the terms of trade, because of the increase in energy prices this year. Now, investors missed the dollar-yen trade, and then they didn't want to buy it at 125. It went to 130. They didn't want to buy it at this level. 135. They don't want to buy it at this level. So the paradox is that we had a massive move in dollar-yen, and investors are actually not long.
They're not long the yen because they see the potential for further weakness, which really drives a main question that a lot of people have in the market right now, which is everybody overly long with the dollar? Have we basically reached a peak here? Is the strength that we've seen simply a weakness in everything else that could get changed if there is a policy shift? Or is this something about a global recession and the dollar being the remaining haven and the remaining hedge for risk assets?
Positioning is not actually stretched, but obviously the question of whether the dollar has peaked is out there. Now, our view is that the dollar will remain strong for now. It can strengthen further, but the main point is that it will remain strong. For the dollar to weaken, you need the Fed to be more concerned about growth than about inflation. And we heard from Powell this week, this is not the case. We also need the ECB to be more hawkish. And so far, we're seeing a very cautious, gradual approach from the ECB, and still a lot of questions about how they will address fragmentation risks. So the conditions for the dollar to start weakening are not there yet.
Thanos, why have we not seen more calls of parity reprised as people see sort of stasis, a consistency all of a sudden at 105 for the euro?
There are two reasons, I think. First, Europe avoided sanctions on gas, which I think will have pushed euro-dollar to parity. This remains a risk looking forward. The second is that although the ECB is the most dovish central bank out there, with the exception of the Bank of Japan, they have expressed a strong will to address periphery risks. So markets don't want to short the euro before they hear the details of these new policy tools that the ECB has promised. At the same time, before they have these details, they don't want to put more money to work in Europe.
But Thanos, even if we get the details and even if the ECB follows through on the hikes that it says it will, potentially with 50 basis points come September, are higher rates enough to actually support the euro, given the kind of growth outlook we're seeing in the PMI data reflective of that today, a 16-month low?
Exactly. That's a good point. The paradox here is that if the ECB comes up with a good tool to address fragmentation risks, which is very difficult to do so, then this allows them to hike more, which makes the situation for the periphery more difficult. And at the same time, because they are dealing with negative supply shocks, the growth outlook is much weaker than in the US. So while the Fed is trying to address first-round effects from an overheating economy, the ECB is trying to address second-round effects from these shocks. The problem is that the ECB has not even started addressing them yet. So they have fallen behind and they have to move. Most likely, they start moving, the euro could strengthen, but they have to be more aggressive than what we have seen so far. And it is unlikely for the euro to strengthen by too much because the US economy continues doing much better than the Eurozone economy.
Thanos, thank you so much. Greatly appreciate it this morning. Thanos Vampakidis with the Bank of America and Foreign Exchange and G10 at that. Lisa, I want to go back to EM here. I haven't talked to Damian Sassari. Well, he never talks to me, Lisa. I mean, he just ignores me.
By never talks to me. That means every other day.
Yeah, but the bottom line is EM is really intriguing right now. I did an equity look at EM back 10 years, and even at the peak, it was up only like 7% per year. And with the drawdown, seriously, the drawdown we've seen, it's up only 6% per year. That's not good enough.
Yeah, it's been lagging behind consistently, which is one reason why you don't have people flooding back in at the sign of perhaps a bit of more of a constructive look. I go back to what Bill Dudley said yesterday. He is watching some of these developing markets, and particularly the currencies, as a potential stressor that could erupt as the Fed starts to hike and continues to hike. And that, I think, is a really important concern, especially in light of what you were talking about yesterday, the strikes in the United Kingdom bleeding out into a sentiment shift in the face of higher prices and potentially strained food supplies.
And sort of the train story in London, actually the airplane story as well, really fluid right now. Lisa, as you know, Kaylee's distracted. She's in deep planning for next Tuesday's crypto show.
Always.
Kaylee, I just put out on Twitter, Raphael Auer, who I adore at the Bank of International Settlements, And he's talking about this con job of miners' extractable value. Can you explain to mere mortals like me why crypto has a different rule book and affecting transactions from me buying the marginal share of Apple Computer?
Well, Tom, I don't think it's so much that it has a different rule book as the rule book is still being written for crypto. There are still a lot of regulations that need to be put in place as to how these markets operate, especially when you see liquidity issues rising over the last week or so that we have seen. And on the point of miners, they're not actually having to sell their Bitcoin holdings, which they never wanted to do because of these liquidity issues.
21,000 on Bitcoin. Some have had the Kool-Aid, others drink Tang. It is extraordinary interesting weather in New York. Coming up, the president of Lithuania. This is Bloomberg.
almost the end of the year, but Bali is still quiet and empty. I am here in Kuta Legian, one of the main walking streets here that is used to be a tourist spot for beach, dining, shopping, but many shops here are still closed. Most of the outlets are either for rent or for sale as they have run out of business.
Saya kerjanya di sini udah lama, udah ada 10 tahunan di sini kerja. Masih sepi sih, nggak kayak dulu. Kalau dulu kan rame, sekarang ya ada 1-2 itu ada, tapi nggak kayak dulu. Kalau dulu rame sekali. Sekarang paling dapat jualan ya 100, 120 gitu, 200 ya. Kalau dulu sih ya nyampe dah 1 juta, 1,5 itu nyampe dapat jualan. Bisa sampai 2 juta dulu. Sekarang nggak pernah lagi dapat segitu. Sama aja. Belum ada turis ke Bali. Masih ya domestik aja.
While Bali has reopened its borders for foreign tourists since October, they're still not coming in. Many international airlines are yet to reinstate their direct flight to the island. Balinese people here really hope they can see more people from Australia, China, and Europe to come visit next year.
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
volatility is part of the global deal at the moment.
We're about 2/3 of the way there in terms of your average bear market.
We see the weaker links, the most vulnerable, have gone down the most.
The market's really worried about recession fears. 50% chance priced in across the U.S. and other countries.
What seems to be priced in right now is a mild recession.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene. Bloomberg Surveillance, International Relations in this hour. A conversation with the president of Lithuania is scheduled. Very important. Maria Tadeo will handle those chores. Katie Lyons in for John Farrow. A well-deserved rest for John. Lisa, we don't even want to know where Farrow is, do we?
We definitely don't want to see pictures. No. I mean, we are very happy for him, except just don't tell us. That's
I'm in aisle 6 of Whole Foods looking at tuna fish up 82 cents. And you're in aisle 8 of Whole Foods looking at ginger ale going, really?
Yeah, the 7.5 ounces versus 8 ounces, which is the reality that so many people are facing, and the reality that we're going to be hearing about yet again on Capitol Hill with Fed Chair Jay Powell saying, yeah, it's bad, and we're going to fight it. And that seems to be the tone as things get a little bit darker, at least in markets and for economic projections. It
is a mess of a Thursday out there. We've got jobless claims coming up here. But, Lisa, I'm sorry, I've got a lift. And as I mentioned earlier, we've got a draw up in NASDAQ, 4 straight days up, touching 5%. Granted, it's in a bear market trend. I get that. But it's a drop.
Okay, I'm actually not watching that, and I'm glad that you're keeping an eye on it. I'm not giving a lot of credence to the draw up that you're giving. I'm going to be really honest. No, it's not just gloom. I'm looking at oil. I think that oil is the most fascinating metric on the board today. Second day of declines at a time when people still see a shortage in the market. This is pricing in demand destruction. It is pricing in recession. Is this the last shoe to fall? Are we heading toward an Ed Morse future? Or is this just also a pause in this trajectory upward? And how does this factor in to the expectations for recession?
Kayla, let's partition that. This is really important. There's many other people out there with an academic study to 120, 150 a barrel, maybe some gloom even higher, and others, including Mr. Morris at Citigroup, really push against that and say, guess what? High prices solves its own problem.
Right, the cure for higher prices is higher prices, and Ed Morse is down at what, $80 a barrel by the fourth quarter?
85, maybe. Who's counting?
The point of the story is it's significantly lower than where we are now, and I know we're going to talk to Amrita Sen of Energy Aspects later this hour, but she has been on this program in recent months talking about how oil could easily go north of 150 because of the supply side issues relating to the war in Ukraine, and yet we've seen oil unable to even breach 120, and that seems to be a reflection of the demand concern that's out there, even as the supply side remains incredibly tight.
Going to do the markets right now. We're going to lead off with Russia, where there's some ruble chat out of their important finance minister, where they're going to do FX transactions in ruble, giving ruble a lift. Turkey out moments ago, holding their repo rate at 14%. In the real world, futures up 27, Dow futures up 145. The VIX, I'm sorry, it's a draw up. We've gone from 30, 29, 28.98, I'll take it. It's a 28 handle on the VIX. A 2-year yield is 3.02%. Gargi Chaudhry aged as she came in, looking at a 2-year back under 3%. Let's go to the brief right now to get to Gargi Chaudhry. Lisa, what do you have?
So we've got a bunch of data coming out today, including U.S. initial jobless claims coming at 8:30 a.m. Have we seen the best of the employment reports? Do we start to see jobless claims tick upward, as we do expect that to be the likely pathway of transmission to a softer economy, less demand, and possibly bringing inflation down? Then at 9:45 a.m., we also have S&P Global U.S. June manufacturing services and composite PMIs. How much do we see the slowdown reflected in the manufacturing and services data? 10 a.m., Fed Chair Jay Powell heading back to Capitol Hill, giving a second day of semi-annual testimony to Congress, this time in front of the House Services Committee, Financial Services Committee. How much does he give credence to this idea that a recession is much more likely and that a hard landing, meaning a deeper recession, is potentially more likely as well? As Lindsay Piegza was talking about, that she views it as a 60% chance that it is a deeper recession versus the 40% that we get to something shallow and brief. At 4:30 p.m., the Fed board announces results for its bank stress tests. How much do we get some sort of reprieve in the sell-off that we've seen in the bank stocks on the heels of those, as the Fed tries to come up with the worst case scenarios? Tom, I'm more interested in what are the worst case scenarios for the Fed at this moment? How deep does the recession go? What kinds of financial markets disruptions do they look at? I mean, if you want a gloom situation, think about what the Fed stressors have to do. I know, but I just imagine those conversations that the Fed stress testers have. Well, let's put this in the parameters.
Not only that, but the timing of recession, the guesstimate of its depth as well. To me, it's hugely random. I'm going to go to Jeffrey Frankel at Harvard, who's done the best work on this, but I'm sorry, Lisa, it's a difficult sport. We'll let Chairman Powell do that, I believe, this morning with the House. Right now, for those of you with losses in bonds, that's called price down, yield up. Gargi Chaudhary joins us, head of iShares investment strategy at Americas. She's been in the trenches in the bond market for a good number of years. You've never seen this, and far more importantly, Gargi, I've never seen this. How is BlackRock adapting to a general U.S. total return index down some 13%?
Good morning, Tom. It's great to be here. So obviously, we came into this year expecting bond yields to be higher. And that has worked out. I think what has been harder to understand in the markets, or what has been harder to react to in the markets, has been this incredible volatility in the front end of the curve. So just last week, when you looked at what 2-year yields did, just moving 6-7 standard deviations 2 or 3 days in a row, I think that's been hard for investors. I think we are telling our clients that, number one, please don't rush to cash. Please stay invested. Maybe stay invested in a more defensive manner. Stay invested in minimum volatility sectors of the market, stay invested in more defensive sectors like healthcare. And then I actually think that moving to the front end of the markets, in the bond markets, makes some sense. And of course, inflation-linked bonds, my favorite asset class, front end of inflation-linked bonds also, especially with the backup that we've seen, make a lot of sense. But look, it's a tough market out there. I think the main thing that we're telling investors to do is not to move to all cash.
Well, Gargi, there's a lot to unpack there, and I actually wanted to get your views on oil, but let's sit on the front end of the yield curve, which we're seeing rally. People are taking up what you're putting down, saying perhaps it's a time to go into 2-year yields, for example, 2-year bonds, and send yields even lower. The volatility that we have seen, does it indicate bond market dysfunction, or does it indicate just a complete lack of understanding of what the Fed's response mechanism will be?
I wouldn't call it a dysfunction in the bond markets at all. I think that we haven't been in a situation like this where the Fed is changing their policy narrative so quickly and responding to the data as it appears. So, last week when we saw the CPI print, and right after that, we saw the University of Michigan survey, and then we got the Wall Street Journal article about a 75 basis point rate move. We haven't seen things like that for a long, long time. So it's not a dysfunction. It's just a market reacting to a Fed that is injecting, unfortunately, a fair amount of volatility into the markets. And it was interesting to hear in the testimony yesterday that Chair Powell said that they don't want to inject further volatility. But unfortunately, that is something that they have been doing. Perhaps you can argue that they've had to do that because inflation has been so much higher than their expectations. But no, I wouldn't call it a dysfunction. I think it's just a reaction to the volatility, especially in the very front end of the yield curve.
Gargi, perhaps it is their doing that we do have this kind of volatility, but how much is it also the doing of the uncertainty of the backdrop in oil, for example? And I do go to that because a lot of people are looking at this as a canary in terms of global growth. What do you make of the sell-off in oil, even as people talk about a tight market?
Sure. So it's a sell-off in oil and the sell-off in the energy sector in the equity markets last week, down, 17%. That was sort of eye-catching. And I think part of that is obviously pricing in of recessionary risks that are moving higher. Whether or not you expect that to happen in the next 12 months or 18 months, you have definitely, most investors have moved their expectations of a recession higher as they've responded to this higher concept of, Fed funds going up to 3.75% at its peak. With that, I think it makes sense for oil and energy sectors in the equity markets to have a little bit of a pullback. I certainly don't think that we're going to go back to sort of levels that we've seen in the past, like $60, $70, just because the demand-supply mismatch is so high. I think there's a structural reason that we all know that oil is going to be higher for some time. But I think pullbacks are actually healthy, and I think that it allows market participants to sort of get back to some of those positions. I mean, I think the energy equities are obviously something that's going to do well for some time.
Yeah.
I think the pullback allows us to re-enter some of those positions.
Well, and energy equities have been the one safe place to hide in the equity market on a year-to-date basis, even if that hasn't been true in the case of the month of June. But as we talk about recession and growth fears, can you really be going into some of those value, more cyclically oriented areas, or is it going to be a rotation back to growth?
I think that you have to, be a little bit more thoughtful about portfolio construction, especially as you enter into a slowdown period. So some of the things that have worked in the past aren't going to work. But at the same time, it can't be as simple as value versus growth or large cap versus small cap. I think it has to be a bit more nuanced. And what I mean by that is I was talking to Tom earlier, and we were saying that, obviously the defensive sectors make a lot of sense. But then within the cyclical sectors, I do think we can make a case for energy equity. And the reason I say that is because the balance sheet improvement that has taken place over the last, decade, but more recently, the improvement that has happened because of oil prices staying at a higher level for a period of time.
So not that Larry Fink's watching, but are you predicting $150 barrel oil?
I am not
The
predicting.
Commodity Act today for BlackRock?
Certainly not predicting any levels on the oil price, but just saying that the equities of some of these oil companies are at a better state than they have been.
Gargi, thank you. Gargi Chaudhary with us with BlackRock this morning in fixed income, not in commodities, Mr. Fink, I should point out as well. Lisa, I look at the screen, and I'm sorry, I'm looking at a VIX of 29. I mean, life is not that bad. The Bramo gloom is unfounded.
Thank you, Tom. That's your opinion.
It's not just Bramo gloom, Tom. Remember when we talked to Bill Dudley yesterday, and he said a recession is inevitable in the next 12 to 18 months?
Yeah, but honestly, Tom, let's just put this in the record. I hope I'm wrong. I hope that people just think I'm Chicken Little. I hope that we eke out something like a soft landing.
Jeff Yu in the 8 o'clock hour. Stay with us. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. It was Fed Chair Jerome Powell's most explicit acknowledgement yet that raising interest rates could lead to a recession. Powell told lawmakers that a recession is possible and a soft landing is very challenging. But he said the other risk is that high inflation gets entrenched in the U.S. economy. Powell is back on Capitol Hill today. In China, President Xi Jinping reaffirmed a growth target that analysts say is out of reach. It was the first reference to the target since a Politburo meeting in April. China is expected to miss its GDP goal of around 5.5%. The government's zero-tolerance approach to fighting COVID and a weak housing market are the problems. In the UK, a nationwide rail strike resumed today. The Transport Workers Union says talks broke down Wednesday. The union wants higher pay and a guarantee of no compulsory job cuts. Tuesday's walkout led to a roughly 80% cutback in rail service. Ray Dalio's Bridgewater Associates has built a $10.5 billion bet against European companies. It's almost doubled its wager in the past week to its most bearish stance against the region's stock in 2 years. Bridgewater is the world's largest hedge fund. Amongst the companies it's shorting Sanofi and SAP. The chief of the school district police in Uvalde, Texas, has been put on leave in the wake of the mass shooting there. The state's top police official criticized Chief Pete Arredondo for delaying the confrontation with the gunman at the elementary school. State and federal officials are investigating the police response. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
city of Jamnagar is a money-making machine for Asia's richest man, Mukesh Ambani. His company Reliance has the world's biggest oil refinery complex here in the city. Jamnagar is also where Ambani is making his newest bet, a $10 billion investment in green energy. His ambition is closely aligned with the Indian government's plan to reach net zero emissions by 2070. But Ambani is not alone. India's second richest man, Gautam Adani, has committed $20 billion of investment over the next decade. But India's massive dependencies on fossil fuels have some environmental advocates questioning the realism and sincerity of those green ambitions and those of its two biggest billionaires.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month and all year long.
By suspending the 18-cent gas tax, federal gas tax, for the next 90 days, we can bring down the price of gas and give families just a little bit of relief. I call on the companies to pass this along, every penny of this 18-cent reduction to the consumers. There's no time now for profiteering.
The president, and over his left shoulder, for those of you on radio, the billboard 18 cents per gallon. Wow, what a tepid response. In the Washington Post this morning, Steny Hoyer of Maryland making very clear, maybe, or something along that line. Let me do a maybe data check here. It's sort of a nudge market here into claims. We'll do that in an hour and 10 minutes. Futures up 27, Dow futures up 146. The VIX impresses me, 29.08. It doesn't impress Lisa Bramowitz. Dollar, I'm going to call it a churn. Kitchukes talking about weak sterling, talking 120, right now 122 on pound sterling as well, and the euro 105.02. Lisa?
Yeah, you know, this is the issue that was we see 18 cents behind Joe Biden's shoulder. How much is this an international issue that in Germany is being dealt with so profoundly differently? And we go from Europe to Washington, D.C. Bloomberg's Maria Tadeo in Brussels and Jack Fitzpatrick in Washington, D.C. As you await your interview with the Lithuanian President Maria Tadeo, we do hear about Germany preparing to ration gas supplies, to start rationing who can use energy and when if they fall below a certain point. How is that being read in the German population as we talk about the U.S. pushing back even for 18 cents?
Well, Lisa, you could hear the panic in the voice of Mr. Habeck, the German economy minister, today, who now says we are in a situation where Russia could decide unilaterally to completely cut off gas from now until the winter. And the timing of this, it's very particular. We have seen that over the past 2 weeks, Russia has limited in major ways. They say there's a technical issue, but of course, the Italians say they lie, and the Germans don't believe it either. We have seen this reduction in gas supplies to those are the two big clients that they have in Europe. The timing, as I say, it's very peculiar because it's really this time of the year in which Europe prepares for the winter. They try to work on the storage. And of course, I
want to be in good shape by the time we get to September. We know that is not the case, and we know that come winter, there's a real concern that we could see at times lights going out, that the German industry could take a big hit, and this is now a perfect storm that's facing the European economy. There's today here in the summit, behind the scenes, a real sense of concern that Russia could now really turn on the heat as a geopolitical weapon. But in many ways, Lisa, I mean, this is a penny drop. I mean, for years, you really relied on Russia. They use it as a geopolitical weapon. You've known it for years, and now prepare to pay the price.
Jack, tell me about the geopolitical or domestic political weapon that the Biden administration has. What is the next step for the president?
Geopolitically regarding oil, natural gas, there are broad conversations about what they can do in terms of exports, but there's not a lot of progress being made in Washington on how to approach those issues. It's a tough political issue domestically for the president, which is why you saw the seemingly already failed attempt to get the gas price holiday. But in terms of what they can do with Europe, with European allies, that has kind of been put onto the back burner because of the domestic concerns. So there's not much of a plan being proposed regarding the U.S.'s ability to help internationally.
Jack, listening to the hearings on Capitol Hill yesterday with Jerome Powell and senators like Democrat Elizabeth Warren, who asked him directly, can the Federal Reserve bring down grocery prices? He answered, no. Can they bring down prices at the pump? Again, the answer is no. Is that not undermining the Biden administration's whole entire thesis that other than Vladimir Putin bringing prices up, it is just the Federal Reserve's job largely to bring it down?
It may undermine the talking point that you hear every once in a while from the president, emphasizing how much of inflation falls on monetary policy, on the Fed. It doesn't necessarily undermine the argument that the president's hands are still tied to some significant degree, because those issues that Senator Warren is getting at are about international supply chains and a lot of things that are also beyond his control. But yeah, that speaks to the lack of a cohesive narrative response from Democrats, and it also, that's I think one area to look at in these hearings from progressives. Any amount of pushback on the Fed trying to pump the brakes on in terms of interest rate hikes. That's what to keep an eye out for, especially as they go to the House Financial Services Committee with other vocal progressives, AOC and others. But yes, it speaks to the lack of a coherent, cohesive answer from Democrats.
Maria, when we talk about the issue on a global level, how much pressure is there in Europe on the U.S. saying, give us more when it comes to gas, help us weather this storm more, and the U.S. saying, we can help you a bit, but we also need to help ourselves?
For sure, and they're very aware of that, and they're very aware of the internal dynamics in the United States. And I think we're about to see it next week. When you look at the G7, it's all going to be about energy. When they meet at NATO, this is really the centerpiece of it. And it's very difficult to separate for Europe at this stage security and energy. They really come together. So you really see the thread between that G7 meeting next week and then, of course, NATO. But I think the Europeans are very well aware that this is something they have to fix. The reality is, I have asked multiple people this morning, what is the plan B? And they don't have one. At this stage, they don't. And that's a real concern, especially when you look at the storage. You have to build it in 2 months. I mean, the clock is really ticking here.
Maria, we're really looking forward to the Baltic State and Lithuania Plan B as well with your conversation, which is scheduled here, I'm going to say within the hour, as we await the president of Lithuania. Jeff Fitzpatrick, thank you so much, in Washington as well. Lisa, we haven't spent enough on this equity market with the VIX now at a 29 level. And I'm sorry, futures elevated up 29,379.2 as well. And the NASDAQ up a sprightly 1.1%.
The NASDAQ is what's catching my attention. How much does it really trade in tandem again? Yields lower, NASDAQ up. How much are people looking for some entry point to go into big tech after the sell-off that way outstripped what we saw in the S&P? Is that sort of the deciding factor? I don't know. It could change, again, in a cup of tang, right? I mean, this is the issue, is that it's been all over the place, and how much is this just a brief rally as we see a further trajectory into gloom?
And Kaylee, what's so important here is, we haven't even talked about it. Get out the calendar. June 30 is upon us. And then 30 days later, the banking ballet, 3 weeks later, the banking ballet starts in earnings. I mean,
yeah,
we're not even there to that reset of the guesstimates of earnings.
No, we're not. You haven't seen the earnings revisions coming down as much as you would think they would, given how far this market has fallen. As seems to be so often the case, the analysts feel like they're behind the curve a little bit, Tom. JP Morgan is in what, 3 weeks from now?
3 weeks.
I can't believe the first half ends a week from today.
It'll give enough time for Pharaoh to have another vacation. 3.03% and the 2-year yields. Stay with us. We speak to the Biden administration. This is Bloomberg.
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
Container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
Without diversity, life would be excruciatingly dull. It's something worth celebrating. It's something that makes us stronger as communities, as businesses, and as individuals.
I see the benefits at Bloomberg on a daily basis. It's beyond flying that rainbow flag. It's about taking the discussions out into the world and making a genuine difference.
Bloomberg Surveillance. Good morning, everyone. Lots of distractions this morning. We await a conversation with the president of Lithuania, critically important along the eastern front of NATO. We'll have that with Maria Tadeo. It's a flexible time. We'll see if we get it in this hour. or the next hour. We're looking at the markets, and of course, lots of news out of Russia, Turkey as well. Turkish lira weaker fractionally, but far more, it is an equity lift in the markets. On the data check, futures advance up 33. Now SPX futures up almost 1%. NASDAQ leads up 1.2%. I'm going to keep this short because the individual stock story matters this morning. Here, Mr. Bostic of the close.
Yeah, the individual stock story, which of course lost a lot of steam yesterday, coming off the big rally on Tuesday. It'll be interesting to see how folks reset today, day 2, of course, of the Powell hearings. But other than that, kind of the all clear when it comes to any sort of economic data or commentary to hang your hat on. Most of the big cap tech stocks are moving higher here in the pre-market. Apple up about 1%, Tesla up a couple of percentage points. Also a lot of activity, of course, in the energy space. Remember, that was the big decliners that we saw yesterday. Seeing a little bit of a boost today, despite there is some sell-side notes out there saying that maybe the bloom has come off the rose. Occidental Petroleum, one of the outliers, up about 3%, and that's largely on the disclosure that Warren Buffett's Berkshire Hathaway increased its stake in the company. It already held about 140 million shares, now up to about 153 million shares. And keep an eye on Century Aluminum. They came out with a statement late last night. Those shares down about 3%. They actually shut down one of their main plants in Kentucky and laying off about 600 workers. And they're saying this is all due to power prices. Remember, out there at the main power hub in Indiana here in the United States, you're basically paying about $213 per megawatt hour. For a company like Century Aluminum, that's more than quadruple what they were paying a year ago. Meanwhile, aluminum prices down about 40% from that peak. Flip it up and real quickly, take a look at some of the earnings that did cross the wire. KB Homes last night, they were good. Orders were down overall, but the backlog was actually up, and that seems to be giving a boost to the stock. Shares up about 3%. DR Horton just crossing the wire just a few minutes ago. And once again, comp sales, kind of a mixed picture. They were down a little bit slightly on some metrics, but some of the other metrics that people look at with regards to average sales price and what people are buying at the restaurant, Tom, at those Olive Gardens and the like, did show a little bit of strength. Those shares up 6%. And after the bell, Tom, FedEx. Tom, have you ever set foot in Olive Garden? I doubt it.
Romain,
Yeah.
le jardin d'olive, c'est bon.
Unlimited breadsticks.
Unlimited breadsticks. What about martinis? Are those unlimited?
Well, they're occasionally they are.
All right, Tom.
Thank you, Romain.
You're
Really, FedEx, there's worth looking at. Lisa?
Yeah, the FedEx is going to be interesting. I think they've got a call today also that will be instructive as for the path forward. Also, the path forward, very much parsing through a hard landing versus a soft landing. What does that look like? And are we already there in a recession? And before someone accuses me of being overly gloomy, is that the better case scenario to be see the weakness now versus later? Gregory Staples has a view, head of North America fixed income at DWS Group, formerly of Deutsche Bank Investment Management. How much are we already seeing, Gregory, a slowdown that reflects a near-term shallow recession that may be the best case scenario for Jay Powell?
Lisa, I think we're already starting to see that. I mean, if you look at some of the real-time economic data, you're talking about housing starts, you're talking about construction spending, we're seeing demand destruction in the energy patch. You talked about that earlier this morning. I think some of the leading indicators are indicating right now we're probably in a slow patch, and we think that's going to continue as we go deeper into the third quarter. It's going to give Powell and the Fed a little bit more leeway to adjust, but it's still too early for them to get off their hawkish forward guidance. It's still too early for them to go wobbly. But the markets are forward-looking, and I think that's one of the reasons why we're seeing a little bit of strength in terms of bond prices over the past couple of days.
So, Gregory, the markets are forward-looking, and they're looking into a soup of unknowns. I mean, honestly, you can forward-look and get it completely wrong because the exogenous factors are moving faster than the markets can even think. How much would you lean into credit, which actually is not seeing the same kind of rally, particularly in the riskier areas, because of some of the recession fears?
Well, I think there's two things going on here. One is the fundamentals still remain quite strong within the credit patch. If you're looking, for example, upgrades to downgrades, they're still positive, whether it's in high yield or investment grade. You're looking at some of the credit metrics in terms of interest coverage. That's still pretty strong, but the flows are coming out of that space. So technically, I think it's still a little bit of a dangerous position, but you get a little bit wider, maybe a little more time. It's a space that we're looking at very closely and are thinking of going back to the long side fairly soon.
Greg, this is really important, and to have you in here with your esteemed career. Ian Lincoln's over at BMO Capital Market and has just put out moments ago a blistering note which goes to the heart of your theory, which is you have to watch the Fed and watch how they express their reaction functions. Are you getting clarity from the Fed? Mr. Lingen says that we're getting a new dynamic understanding of how the Fed is going to move forward. Do you feel that to Jackson Hole, that we have a better understanding of how they will adapt to reaction functions?
Well, I think Powell is trying to finesse it. I don't think that it's very clear for him what indeed the terminal rate is right now. I think that he's got to continue to guide the market towards hawkishness. He can't go wobbly on the resolution to tackle inflation right now. If he does, I think you're going to backslide into looser economic conditions. But he's going to watch real-time data just like everybody else.
Price up, yield down. Is it marginally just within the drift function of a bear market in bonds, price much lower, or can it tangibly catch a bid like it does in equities?
If you're talking about purely because of the possible returns of the lower price action, I don't think we're quite there yet. I'd be cautious about going against what's been a 6-month bear market so far, but I think we're in the 7th or 8th inning of that, and certainly as we get closer to the July Fed meeting, that could be a trigger point. If they go 50 or 75 and the market reverses itself saying they've gone as far as they're going to go, that's probably the time to go long duration, and after that, the time to go long credit.
Okay, so we had Emily Rowland of John Hancock Investments on yesterday, who said she wished her T-shirt arrived in time that said, "I love bonds." She sees value in treasuries at these levels currently. You're not there yet, Greg?
I'm not quite there yet. I mean, listen, the one thing about bonds is they tend to trend very much like currencies, and it's very easy to get into early. A lot of us thought that 285, 295 in the 10-year was a great time to come in, and there was another 40 basis points to go. Is it impossible that we get to 3.5 sometime over the course of the summer? No, not at all. But is it possible that we saw the highs last week? It is. I just want to see a little bit more confirmation that we're slowing before we get really long in terms of our portfolios.
But given how much hawkishness has already been baked in, is it that much harder to have a catalyst for higher yields than a catalyst for lower ones, as the R word is now used so frequently?
I think that's a good point. Yesterday in Powell's testimony, he was quite hawkish, and we're seeing the market sort of shrug off some of the hawkish data that's coming through, but pay more attention to the dovish data. So I think we might be sort of maximum positioning in terms of defensiveness and duration, and that would lead, if you see data start to reverse itself, people going on the other side, and you want to get on that trend fairly early.
So, Gregory, if you don't like being long bonds, at least when it comes to treasuries, and you're not particularly overwhelmed by credit, what are you buying?
Well, we're short duration overall in our portfolio, still being defensive, and that's a position that we've held basically since the beginning of the year. Still a little cautious on risk overall. We're more than willing to miss the first 5 or 10 basis points of tightening, but once we see a little bit more definitiveness in where the market's going, that's when we want to put the positions on.
Okay, so are you all in cash?
No, just short duration, more conservative, up in quality.
I look at the up in quality, and that says full faith in credit. What's the partition now in the analysis of full faith in credit versus investment grade corporate bonds?
I think the place you want to avoid still is those parts of, say, for example, the industrial space that are going to be more cyclical. If we do go into a deeper recession than the market expects, they could suffer a little bit more.
Are they giving you a coupon right now? I haven't looked, to be honest. Do I get paid on Caterpillar debt?
You can get 10-year debt close to 5% now, and that's not too bad. Mortgages are the same place.
As we talk about a slowing economic picture, and as people use the R word, as we've already discussed a few times, Gregory, do you see adequate default risk out there that things could get so bad in credit that it actually means Jerome Powell presses pause at some point?
Well, first off, I want to point out that I've never heard the one economic term, i.e. recession, used by so many people without defining what it actually means. I mean, some people talk about recession as perhaps a negative 3% on growth. I'd say a soft recession is basically zero growth plus or minus 100 basis points. And I'd say we're probably going into a soft growth, meaning, or a soft patch, if you will. 0% growth, maybe a little bit weaker than that. I don't see much worse than that. We're not talking about a first quarter of 2020 recession or fourth quarter of 2008 recession. If that happens, of course, all bets are off, but I don't see that happening.
Greg Staples lifting the market here. Futures up 31, NASDAQ out to up 1.1%. He is in fixed income with DWS. Thank you for joining today. You know, I mentioned this yesterday, Lisa. Greg Anderson, the great Greg Anderson, and Stephen Gallo over BMO Capital Markets are writing piercing notes on EM. They gave a number, Lisa, and I know this is wicked inside baseball, but to consider India rupee at 80 stops me. I mean, all of a sudden we're seeing real EM erosion that's out there. They're looking for weaker India after intervention efforts onto 80 per dollar.
And what does this become a liability socially when you start to import oil, when you start to import food? I mean, this is an oil importing nation. This is a food importing nation, even though they do produce a lot of their own food. How do they deal with the idea that they've got less buying power, Tom?
I would suggest for our listeners and viewers in America, this is stuff I realize it's outside the box of what everybody's talking about. But all of a sudden, Lisa, Jay Powell is central banker to the world again.
And he's central banker to the world in the opposite way that he was before. And this is why I talk about the idea of a currency war being turned on its head, with the strength being heralded and celebrated rather than weakness, as it was 3 years ago, 4 years ago, and you were racing to the bottom to attract capital no longer. And that, I think, is going to be a very difficult thing for Jay Powell to parse when he's got very much of a domestic view and only one consideration: to get inflation down, when a lot of it is not even within his remit.
Kelly, I can't stand it. NASDAQ up 1.1%. I mean, it's 4 days in a row, even 5 days in a row.
Can't stand it, Tom. It was down fractionally yesterday. It wasn't a huge loss, but we were off a couple tenths of a percent on the NASDAQ 100. The question really is going to be, at what point does the buying stick? Because we haven't seen more than, I think, 2 up days in a row on the NASDAQ 100 in quite some time. In fact, usually a big up day is then followed by a down day. When do you see the dip that you actually want to buy and that buying power stick around, given all the uncertainty that is out there?
Futures up 31, the VIX 28.98. That is important. We've come in from that 32 level sprightly, because Kaylee's with us, folks. We would not normally not quote Bitcoin, but 20,633. So Kaylee will stay around for the next section. I'm ready to send on oil. We do that next.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. Both Republicans and Democrats in Congress are signaling there is little support for President Biden's call to suspend the federal gasoline tax. It's seen as a symbolic move by a president running out of options to ease prices at the pump. The president blames much of the increase on Russia's invasion of Ukraine. Germany has triggered the second stage of its natural gas emergency plan as Russia cuts back supplies. That has European gas prices rising in the so-called alarm phase. Berlin will tighten monitoring of the gas market and reactivate some coal-fired plants. The German government warned this week that there could be further cutbacks in Russian gas. U.S. prosecutors say British socialite Ghislaine Maxwell should spend 30 to 55 years in prison for engaging in a sex trafficking scheme with the late Jeffrey Epstein. A federal judge will sentence Maxwell next week. Prosecutors call Maxwell a sophisticated predator. Instagram is testing new ways to verify users' age, amongst them running users' video selfies through an artificial intelligence that can determine if they are adults. Instagram has been under fire from safety advocates to keep children off the app and prevent teens from seeing harmful content. It's owned by Meta Platforms. Bloomberg's learned that Tesla is taking steps to ramp up its output at its factory over in Shanghai. The electric vehicle maker will partly suspend manufacturing at various points through early August so it can upgrade production lines. The goal is to eventually double its original planned target to 1 million cars a year. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Lots happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management. It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
That over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Minority Leader McConnell has already kind of thrown cold water over it. There's very little chance that this actually does get through. This is just a kind of another rhetorical tool of the White House to sort of show that they're doing everything they can on inflation.
Libby Cantrell, she is with PIMCO, and we're thrilled that she could be with us to do analysis here of what Jerome Powell's talking about, how that was taken yesterday, I would say constructively all in all by the market. That construction after a fade, Lisa mentioned that earlier, futures up 29, Dow futures up 158, and the NASDAQ up a full percentage point. I'll call it a constructive tape this morning. This is hugely, hugely anticipated right now. Amrita Sen joins us here with Energy Aspects, and I do want to note we protect the copyright of all of our guests. I can't say enough about the acuity of Energy Aspects notes. You can get them from their people as you can. And Dr. Sen, I want to speak here about demand, which the fears are premature. And what I love about the Energy Aspects note is how geographic it is. The elasticities or responsiveness of demand, it's different on the Pacific Rim than it is in Europe, et cetera, et cetera. What part of your oil demand study now is the most important for our listeners and viewers?
I would say, first of all, thank you, Tom. Very kind words indeed. But I would say we have to focus on Asia, because all the focus right now is on the U.S. in terms of the market, right? And obviously with the U.S. Fed raising interest rates, everybody is now expecting a recession. The questions have moved from, oh, are we going to be in a recession, to how deep is it going to be, to how does it compare to past recessions, whereas nobody is actually looking at emerging markets. Asia is 18 months behind us in their reopening cycle. They have just started to reopen from COVID. And by the way, China hasn't even started to reopen. So there is quite a lot of upside to those demand, even our own demand numbers for 2023, depending on that cadence of the Chinese reopening.
And Lisa, this is absolutely critical. The hyper-analysis in microeconomics of Amrita Sen, different from what we see at JP Morgan, but both of them are completely focused on demand responsiveness on the Pacific Rim. That's the common feature of two different houses.
And sure, there's a lot of distinction in each region. The overall picture, though, is a tight oil market. And Amrita, you highlight that as well. How much is what we're seeing right now a brief cooling in some of the fears of the tightness of the market before we reassert price up for a barrel of crude, especially as some people think that there already is a recession, an R word, baked into the price of oil?
Yeah, I mean, look, have the balances necessarily turned out to be exactly what we had forecast after the Russian invasion? No. Russian supplies are still hitting the market, probably about 1 million barrels per day or more or less more than what we had expected. But they are still down about 1 million barrels per day. But equally, we've had the SPR. At the same time, demand is still coming in higher. So to your point, the market is incredibly tight despite some of those moving parts. I think the bottom line is underlying inventories are so low, spare capacity is so low that you only need a little bit of movement, like such as Libya going offline for a couple of days, can really swing balances from being solvable to unsolvable in the matter of hours. So what we're seeing right now is, again, this fear of a recession turning people to kind of doubt the demand recovery and say, okay, we've got all this SPR barrels, but if demand doesn't keep up, prices are going to come down. But I will also highlight a couple of other things, more technical factors. We tend to get sovereign producer hedging at this time, large producers in North America, even in Asia, and that has started. And it's a low liquidity environment, which means that even take away all the fundamentals, there will be some downward pressure on prices in the near term. But ultimately, especially going into the winter, we think prices are going to head back higher again.
So, Amrita, maybe the best way to characterize this is a head fake, if you believe that this is hedging by sovereign entities. How much of a head fake could it be? How much do you still see energy prices rising heading into the winter months?
I mean, do we think prices are going to go back to $120 or $125 to $140 range for crude? Yes, absolutely. But does that mean that we don't fall $10 first? I think we could definitely go down first. And I think for traders, that matters a lot, right? It's always about the entry point. But I think more in terms of consumers and refiners, ultimately the trajectory is higher. And again, forget crude prices for a second. Think about diesel, gasoline. Those prices have barely moved because the underlying fundamentals are so strong right now. Crude tends to move a lot more with these macro headlines. Product prices don't. And I think that really tells you where the fundamentals are. Yeah. And I think going into the winter, the risk of a diesel price spike is much, much higher.
Okay, well, Amrita, as we talk about going into the winter, let's talk about whether or not Europe is going to be adequately prepared for the cold weather. You had Germany today triggering phase 2 of its emergency gas plan, the alarm phase, I believe it's called. What happens if we start to see actual gas rationing in Europe?
I think there's a real risk of that. I mean, we believe that. Our team absolutely believes that. We've already put together a list of which industry is going to be hurt. So steel, cement, fertilizer, and so on. But I would say that we are starting to see countries restart coal plants. So I think the choice has been made. Again, it was always about kind of green energy versus energy security. I do think we're starting to see the move towards guaranteeing let's keep the lights on. And as long as whoever has coal capacity decides to bring coal capacity back, then I don't think the downturn in industry is going to be as severe as we are expecting right now, just assuming that gas gets turned off.
Amrita Sen, thank you so much. Just a brilliant note from Energy Aspects this morning out of Houston and London as well. Lisa, part of that note down at the bottom is a summary, and this is something I'd say, Lisa, it's in the zeitgeist, but they're really overt about it in Energy Aspects. If we get a China reopening, what does that do to the recession gloom in the United States? Energy Aspects doesn't mince words. It will delay recession.
Because of the supply chain issues, because of some of the gears
the logistics
of the economy,
get
the
better.
logistics starting to improve. With respect to oil, though, it might be the opposite. If demand picks up, you might get oil prices go up. I'm not saying it will delay, that it won't delay the R word, but it's a complicated moment. And considering that could be the swing factor for whether it's a hard, it's a soft, it's an up, it's a down. I mean, this to me shows how much uncertainty when you look at a crystal ball. It's pretty much murky.
Come on, Kaylee, look at the gloom that's out there. And I don't mean to beat on Bramall gloom. There's a lot of different other qualities of gloom that are out there. The chairman opened his comments yesterday to Brown of Ohio and said we have a strong economy. Yeah. That's what came out of his mouth.
He doesn't think that the chances of a recession are all that high, but he also couldn't rule it out, Tom. And while we're talking about...
Of course he can. What's he going to say? I guarantee you no recession.
Well, he could have sounded less gloomy.
Yeah, and while we're talking about China, there's a question of how long it's actually going to take China to reopen. You had Xi Jinping, the president of China, talking overnight about reaffirming that 5.5% growth target. There is very few economists who actually think China's even going to be able to achieve 5% this year.
Yeah, I would agree with that. And again, our energy aspects, it's all about logistics and nuts and bolts of shipping and containers and such. We have a better market. Futures up 31. NASDAQ up 1. I'm doing a Faro data check. I'm not mentioning the Dow. NASDAQ up 1%.
Not mentioning the Dow by mentioning
John
the
would
Dow.
say, oh my God, I got to quote the 2 year,
Called in.
3.04%.
Look at the Dow.
Jeffrey Yu will help us next. This is Bloomberg.
nuestro estudio, nuestro experimento, no hemos pintado todos los edificios de blanco, sino estos más asequibles de pintar. Y ya hemos detectado reducciones medias en el área metropolitana de 0,8 grados aproximadamente en un periodo de ola de calor y con picos máximos de 4 grados de disminución en un momento puntual del día, en una zona puntual del día. Y como dices, en una ciudad como Barcelona funciona incluso mejor que las zonas verdes, según las modificaciones nos detectan incrementos, o sea, disminuciones de temperaturas mayores con tejados blancos que con incrementos de zonas verdes como tienen planteados el plan director urbanístico.
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
folks who get paid to do this, i.e. at the Fed, have never gotten recession forecasts correct.
We're seeing the largest amount of financial tightening that we've seen in decades.
The Fed's discovered that they can control interest rates, and they seem to like to do that.
I do think recession risks are going up each time the Fed moves.
They're definitely going for a soft landing. It's just going to be almost impossible for them to pull it off.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Parsing through the many shades of the R word. Good morning. This is Bloomberg Surveillance on Bloomberg Radio and Bloomberg Television. Tom Keene, Jonathan Farrow, and Lisa Abramowitz. John off on a well-deserved vacation. He'll be back next week. And Kaylee Lyons in, which we are very glad about. And Tom, right now, it's the R word about Jay Powell. And basically, we can move past what we're going to hear from him at 10 a.m. today into July 27th.
It's a lot of amateur coverage, Lisa. I'm not going to mince words. Economists look at this, led by the great Jeffrey Frankel at Harvard University. Totally different. Martin Feldstein, who founded NBER, in my opinion, he would say this is all wrong. It's way more nuanced. And to get to recession is a much more nuanced, complicated exercise than just blathering about the R word.
Okay, so if I'm going to use your phrase, let's stop the show. Where are people getting it wrong? Where are they underestimating some sort of dynamic trajectory for the U.S. economy?
The partial differentials of consumption, investment, government, and critically, export-import dynamics that, Jeff, you can talk about are underestimated. The nuances between those to get to 0% or negative GDP. And the other issue that is there time and time again is how every recession has a different character. That's always underplayed.
Of course, Kaylee, does the Fed have to cause a recession in order to get inflation down? In other words, is it a self-fulfilling prophecy that the more strength there is in the economy, the further the Fed has to go?
Well, that's the question, and it was a question posed to Jerome Powell on Capitol Hill yesterday when he faced Senate lawmakers. He said he doesn't think that they have to cause a recession in order to get inflation under control. The question is whether or not the markets actually believe him. And again, you have to define it. Our John Authors, on his column on the Bloomberg Opinion piece today, was talking about how you don't necessarily know what a recession is, but you know it when you see it. And is that the kind of place that we're in right now, where we'll know it when we see it, but no one can tell us exactly what it is that we're going to see?
So, Tom, you were talking about this earlier, about how the U.S. recession may hinge entirely on China and whether they have a reopening, whether demand starts to pick back up, whether that economy starts to revive. So if you call the Bramo gloom, let's talk about the keen constructiveness or the keen optimism and sort of how much that really hinges on what happens with supply chains and what happens over in Asia.
Yeah, I mean, I don't know how to weight that, frankly. I think there's so many uncertainties there, but certainly the core theory we see across equities, bonds, currencies, commodities is demand will come on specifically from the Pacific Rim. And that's the theory there that we heard from Amrita Sen, that China is important to the American recession discussion.
Yeah, and right now what we are seeing is a keen constructiveness in markets that you've been talking about, Tom, and help me out here. But we're looking at NASDAQ leading the way, which I find interesting. How constructive is the NASDAQ leading the way versus perhaps trying to find a bottom after a massive bear market? Now down, up, I should say, 0.9%. I've gotten used to saying down because it has been that for so long. S&P futures up 0.7%. The dollar kind of all over the place, depending on what cross you look at. It's got a strength versus the euro declining 105, but off some of the earlier lows, and yields lower. This I find fascinating at a time when so many people are expecting a Federal Reserve to come out, Tom, and be incredibly aggressive. We're still seeing a rally into bonds, perhaps saying that the market's going to weaken, the economy is going to weaken far before the Fed has to go.
I think there is there, but has there been much curve steepening? And the answer is no. I think that, it's come in. Atlanta GDP is a 0% as well, but I think it's hugely fluid right now.
And we're looking at crude with a little bit of a bid, but it still is early. Jeffrey Yu thinks perhaps it's early to use the R word, as do many people who are accusing me of Bramo gloom, which is fine. Jeffrey Yu, senior EMEA market strategist at BNY Mellon. What's your view as far as, Jeffrey, whether we've gotten overblown with the calls for the R word?
I do think it's overblown to some extent, and let's bear in mind the
S&P, NASDAQ, that is not the entire US economy. Low percentage of US companies, large and small and medium size, are actually listed. So I don't think it would reflect, what Main Street feels as well. So on that side of it, let's look at the labor market. Spending power is very strong. But going back to the China supply chain element, there, I would say the risks are still to the downside. We're hearing Macau locking down, for example, apart from the casinos, which is not really a surprise. But if this spreads across the Greater Bay Area again, that's 11% of China's GDP, crucial to global supply chains. So I would continue to be relatively cautious on that contribution. But the US on the domestic side is still holding well.
Well, Jeff, to the point about supply side issues that could continue to feed into inflation, I mentioned the John Author's column earlier, and he cited something from PIMCO where they said there is a risk here that we run into an anti-Goldilocks economy that will be both too hot in terms of inflation and too cold in terms of growth. Is that actually a worse outcome than just a recession, but inflation getting under control?
So it's back to the stagflation argument, right? How do you actually get inflation under control, especially if a lot of the supply side issues are beyond central banks and policy control. So I guess the least worst answer there is, try to guide towards a soft landing. So as much as central banks who can push on reining in credit, on reining in demand, at the same time, you want to supplement the household as much as possible to make sure the cost of living crisis, inflation, people are feeling it, that their consumption doesn't fall off a cliff either, especially relevant in the likes of the US and the UK, which are services-heavy economies.
Jeff, you started by saying that perhaps the R word, recession, is overblown. Where is it overblown in markets right now?
I think, so if you look at where market pricing is, it depends where. Maybe in the US, at best, it's 50-50 in terms of pricing in a recession. Eurozone, less so. We saw the French PMIs in an immediate reaction today within the European bond market. So there it's probably not overblown. UK, we've had GDP monthly contractions already, and the BOE is outright forecasting GDP contraction for the whole year for next year. So that's where on an individual country level basis, you have to look at the idiosyncrasies. But with the US and China can stimulate, and that can lift US growth, can lift US growth and global growth, keep it going. The question is, why isn't China doing anything right now on the monetary and fiscal side? They're still very, very tight.
Jeffrey, I want you to weigh in here on the oddity that is the Bank of Japan experiment and what it means for finance. Let's start with the power that they have. Do they have the power to continue yield curve control, or do they fall to a market pushing against them?
Yes, they do have the power to continue yield curve control. Let's be very clear about this. Any JGB trader will tell you trying to short the JGB market against the BOJ has lost you money for probably like 3.5 decades right now. That'll continue to be the case. But at what cost to the underlying Japanese economy? Now, Kuroda's had to apologize to the Japanese public for inflation. You cannot, buy a meal with a 500 yen coin anymore. People will feel bad, but ultimately it's not going to be outsiders, quote unquote, people trying to go against the JGB market. It's going to be domestic and domestic politics.
How important is the shift in their flows of trade and the idea that the stereotype is Toyota's abroad, and the reality is there's been a change in their import dynamics, their flow dynamics? How critical is that multi-decade shift?
I think that is very, very critical. But does Japan want to rebalance? If there is a plan to increase domestic demand, I'm sure there always has been, bring down your current account surpluses, then there's going to be no less yen to recycle in any way. And then the Bank of Japan's role will actually be much, much easier. But again, going back to Governor Kuroda, is he willing to actually bite the bullet and identify domestically driven inflation? Right now, he's saying wrong kind of inflation, don't want to push it back. But the problem is you find out you're wrong when it's too late.
Jeff, I want to get you in trouble with the General Counsel of Bank of New York Mellon. Real simple here, to 2 decimal points on yen, where does Kuroda break?
Well, Kuroda break, I will be very cautious in my language there, but saying, if, let's say, with the 500 yen coin, you can barely buy half a bowl of ramen, then there's going to be a problem. But the higher it goes right now, the more problems that he will face within the public, the domestic public. That's his constituency he needs to be aware of.
Jeff, you skirting General Counsel debate there as well at BNY Mellon this morning. I mean, Lisa, Jeff, thank you so much. Greatly appreciated. Lisa, this is a huge, huge deal. And that when you go out there as an investment house, particularly the Japanese investment houses, and you start pontificating about yen 140 or yen 150, there's some real internal pressures on that.
especially at a time when they have to import so many goods. They can't really do that for the same kind of price. And this is not exactly the Japanese economy that they saw 20 years ago.
Yeah.
What are they going to do, though, in terms of allowing this to happen without giving traders a payday, without saying, you were right, we couldn't do it? How do they save face? Because they want to do it on their own terms.
And the history of this is simple, going back to the rationalizing of industrial and particularly banking Japan. It took forever and ever to get to that rationalization. I'm going to say off the top of my head, it took 12 years, but it was difficult to say the least. We've really worked into a stasis market here, Lisa, 20 minutes away from claims.
20 minutes away from claims and perhaps a little bit less than 2 hours from Fed Chair Jay Powell not saying anything that he didn't say yesterday, but I think it's all countdown to July 27th. And Tom, that's what I'm looking at, especially with all of the uncertainty about oil prices. And I'm looking forward to hearing some of the guests and the commentary coming up for that perspective.
Kaylee, the survey of claims, 229 down to a better statistic, 226 as well. I guess that's still better than good. That's the strong economy Jay Powell was talking about.
Yeah, exactly. He thinks the labor market is good enough to hold in there, at least to a certain degree, while the Fed hikes. The question is for how long, and at what point do we start to see that unemployment rate ticking higher, and to what height are we talking?
Now, an important data point this morning with claims. There's some other ideas coming on S&P Global PMI as well, but really tomorrow you'll have to be with us on a Friday for the University of Michigan statistic. That's at 10 a.m. tomorrow. The view forward 5 and then out another 5 years, out 10 years as well. Stay with us. Claims here in 19 minutes. Futures up 22. Dow futures. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. Fed Chair Jerome Powell is back on Capitol Hill today for the second of 2 days of testimony. Yesterday, he made his most explicit acknowledgement yet that raising interest rates could lead to a recession. Powell told lawmakers that a recession is possible and a soft landing is very challenging. But he said the other risk is that high inflation gets entrenched in the U.S. economy. In China, President Xi Jinping reaffirmed a growth target that analysts say is out of reach. It was the first reference to the target since a Politburo meeting in April. China is expected to miss its GDP goal of around 5.5%. The government's zero-tolerance approach to fighting COVID and a weak housing market are the problems. Russia used new rules to pay its latest slate of bond coupons in rubles. However, neither of the bonds have terms that allow for settlement in that currency. Moscow has just days remaining before it potentially slides into its first foreign default in a century. Russia has billions of dollars it could use to pay, but mounting sanctions are cutting off avenues to transfer the cash. Rescue and relief teams are struggling to reach survivors of a deadly earthquake that hit the remote southeastern region of Afghanistan. At least 8,000 people were killed and hundreds more injured. The Taliban has urged international aid agencies to help. Global News 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Biden administration's standpoint, I think that you could say figuratively and literally they're out of gas. You can't guarantee that that's going to make its way to consumers. The way that the gas tax is levied in the U.S., it's not at the pump level. Right now, I would think priority one is to make sure that we unleash America's potential as far as the ability to produce more oil and gas.
The Republican from Virginia, Eric Cantor there, of course, with his public service to the nation with Mullis right now and Vice Chairman speaking to Bloomberg in London. Right now, I'm going to focus on energy here because that is the point of the moment. Futures up 23. The VIX sprightly 29.11. Brent crude, the global price at 111.67. That is down from a 124 per barrel to 112 per barrel. And West Texas Intermediate at 110, and I'm assuming Amos Hochstein, Presidential Coordinator for Energy Security for the President of the United States, would like West Texas Intermediate quickly to get back to $80 a barrel. Amos, I'm going to cut to the chase. You read the Washington Post, Steny Hoyer and others, lukewarm here on the microeconomics of price theory of an 18 cents tax on a gallon of gas. What's the plan to get oil back to $80 a barrel?
Well, good morning, Tom. First of all, thank you for having me. Look, since the late fall, when Putin had amassed his troops around Ukraine and ultimately the invasion, followed by global sanctions, the price of gasoline at the pump for Americans has gone up about $2, and diesel probably a little bit more than that. So what we are looking at is this historic increase in price as a result not of normal economic times, but under a time of war, at a time of global security instability that is affecting the market. And as a result, as we go into the driving season this summer, the president really wants to give a break to American families during these 3 months of the summer. And that's why he's asked Congress to suspend the 18-cent gas tax. And he's called on governors to do that the same. So if the governors match that, we're talking about 50 cents a gallon less. But I want to answer your question, Tom, directly. Look, we have done everything that we can to encourage the industry to increase production, which they are going to this year. We're going to get to record oil production by the end of this year or the next year's first quarter. The president has ordered the release of 1 million barrels a day from the Strategic Petroleum Reserve.
Right, okay.
And
Amos,
he led the effort to do 240 million barrels.
Amos,
that's a lot.
Here's the problem, and I know you're sitting in the Oval Office with a Bloomberg terminal next to you as you talk to the president, and you can bring up Log West Texas Intermediate quarterly like I can. Anybody can do this. Baloney. It's about distillates, and it's about not in my backyard. How is a centrist Democrat going to explain to left Democrats that they need to come up with a not in my backyard policy to advocate greater distillate capacities in America? How do you do that?
So, Tom, you raise an excellent point that people tend to focus a lot on the oil production, but in reality, that's not the issue alone, right? During the pandemic, just during the years of the pandemic, we lost a remarkable amount of refining capacity in the United States. And those refineries that went out, some of them are gone and they're not coming back. We know that. One of them is turned into a terminal. The others, though, are there, and we can invest. Before we start talking about building new refineries, we can bring back, potentially, the old refineries that have been taken out of commission that are still there. And what the president has asked is for the industry to come to Washington to meet with Secretary Granholm and to bring ideas. As he said in his letter, look, he has taken extraordinary measures over the last several months in a number of areas, both in energy and beyond. He is willing to take those measures again. We're asking the industry to come and to give us their ideas. What do you need from the federal government, from us, that we can to work with you to increase the capacity, the refining capacity in distillates in order to get gasoline not only produced, but then ultimately get gasoline and diesel to the right places around the country.
I mean, Lisa, what's so important here, what Amos is talking about, is what are we going to do to politically shift the distillate debate? To me, that's the heart of the matter.
The other heart of the matter, Amos, is this idea that the response to that letter that you were talking about from the president, from Exxon, from Phillips 66, from a whole host of other companies was that the current administration has had obstructionist policies when it comes to the oil and gas industries, and that they have not been very clear. What is your response at a time when they have been increasing production and they invested more than they brought in during the heart of the pandemic?
So, look, that's the difficulty here. People say that we are standing in the way of increased production. But look at the numbers. Look at the increase in production under the Biden administration. It's hard to argue that we have done anything to stand in the way of increased production. There's been a rise in oil production. We know that by the end of the year or the beginning of next year, we're going to hit record production. So on average, the oil production in the United States in this last year and a half has been higher than the one under our predecessor.
Excuse me, Amos, but have you met with
those records, Lisa?
Have you met with the CEOs of the big oil companies to talk about this and to talk about how things can be clearer for them to produce more? You have. And are there going to be certain
and I can
scheduled?
tell you. Well, sorry, go ahead.
No, I mean, are there going to be scheduled changes in terms of more specific policies that you'll put out there that you think will allow them to refine more or create more production in the near term?
Well, I think that they have, my point is that they have the tools they need. When I meet with the oil company executives and the CEOs, and I've asked them over the last several months, what do you need from us? And beyond what we've talked about the last several days in the press about the tone, what do you need? They don't need anything. They all say they have what they need. There are some labor shortages, there are some spare parts and so on, but they don't need policy changes from the U.S. administration. They have what they need. In fact, when it comes to federal land, they have more than what they need. But as you and I both know, federal lands where government leases are less than 10% of the overall U.S. production. So the companies actually don't need anything. What they do need is bankers in New York and their funders, and their investors to say, use the profits that you're having under these record prices for the last several months and invest them back into production, invest them back into refineries, invest them back into equipment.
Almost, if I could just jump in there.
That's where the rub beats. Sure.
It's not just about the availability of the crude. It's about the ability to turn that into product, to refine it. Refining capacity is really a critical issue here. And when you speak to an oil executive, they say, why would I invest in a new refinery, which is a long-term investment, when it is known that there is an intention to get to net zero, albeit in a few decades from now? They want to pivot to clean energy. So what is your messaging to CEOs when you're asking them to pump more, also knowing that eventually you want to wean off of fossil fuels?
So 2 points. One, you're 100% right. It is not just about the crude oil production. It is about refining. And as I said before, we lost a lot of refining over the last several years, specifically during the pandemic, and we'd like to see that come back. But you raise a fair question. Why do you make those investments? And that's what we have to talk about. We need to make sure that we have enough oil and gas in the economy now over the next several years to meet the demand that we have in the economy. And you're right, we're not shying away from our climate goals, and they're aggressive, and we want to accelerate. We want to accelerate the movement to electric vehicles. The goals of 2030, I know the goal is about 50% of new car sales, 2035. You have several American companies and global car companies saying that by 2035, 100% of their vehicles will be electric. So, and that's just new car sales. So we'll have a tail on that as the rest of the industry catches up. So the argument that we don't want to invest in refining or invest in oil production now because of these policies, I don't know that really follows through and meets the facts. We know we have the demand, so I think that we'd like to work together with the industry. Tell us what you need, and tell us how you plan to use your record profits, investing back into the industry, into production, into refining, so that Americans can pay a little bit less at the pump and have the products that they need during this time.
Amos, we just have a little bit of time left. Has there been any discussion about reducing demand or possibly putting out some sort of guideline to pull back in terms of how much people use, akin to what we're seeing in the gas space over in Germany?
Well, first, I think on natural gas, Europe and the United States are vastly different in our systems. Our price here is about $6. Theirs is about $40 on natural gas. But look, we have provided record investment through the infrastructure legislation that passed into mass transit and into rail. These are the things to convert people from, if we had a better rail and mass transit system that was efficient and fast, then all studies show people would move from using vehicles to using mass transit. So yes, we'd like to put the investments to work. That's what President Biden has been offering all along. How can we move people away from driving their cars to mass transit and to rail? And how do we move from gasoline cars to electric vehicles, which will also reduce the demand for gasoline? But we have to also be realistic that we need that supply today as we get towards that better future that you're talking about.
Thank you for the brief. Amos Hochstein is with the White House and with President Biden with energy policy this morning. Futures up 23, Dow futures up 115. It's a stasis, but a lift to the market as well. Lisa, I look at West Texas Intermediate after with Dr. Hochstein, 111.63 on oil, still a long way from the comfort that we had at $80 a barrel.
There's not a lot of comfort in the transition that we're seeing right now from a world very much dependent on fossil fuels, and that transition that Amos Hochstein was talking about with more people buying electric vehicles. And this is really the tension underpinning, honestly, all the conversations that we had in Davos, Tom. How do you get there? How do you invest in some of these refineries and other things if you know that in 10, 20 years, people are going to try to phase them out?
Well, we're just going to have to see. I mean, it's a debate here. My debate is on the distillates, completely away from production. I get the constructive story on production, and price will come out in that. But to me, it is a distillates destruction, not only in America, but worldwide. It's way more about the Baytown refinery of Exxon than it is about anything else. Futures up 20, Dow futures up 100. We're 4 minutes away from claims, 4 minutes away from Michael McKee. This is Bloomberg. Good morning.
That it's highly transmissible. We know that 2 doses of vaccines, Pfizer vaccines specifically, neutralize the virus, but not as efficiently, because various studies showing that reduction up to 40-fold, meaning that a 3rd dose is a must for it to successfully neutralize the variant. What we don't know is still that what are the effects of mix and matching between vaccines, and what are the capabilities of antibodies produced from this mix and matching in neutralizing Omicron. Because as we know, many parts of the world use different types of vaccines. And that would be a great data to look at. It will be also great to look at, because majority of the studies done uses a small sample number, and most of the time when you translate it to real world, the data changes. So it will be really good to look at large-scale data of the ability of antibodies from vaccines to neutralize this variant. Grateful here today that the virus, Omicron variant, still uses ACE2 receptor as its main entry. It means that all of the vaccines which are designed with spike in mind still works. Imagine if it uses a different receptor other than ACE2. None of the vaccines would work today. So I think that is the best news that we got from all these studies which came recently, the past couple of days.
Surveillance, and good morning to you. The chairman of the Federal Reserve said yesterday it is a strong economy, and a strong economy always starts and ends with the dynamics of our labor economy. We migrate there right now with Michael McKee as he and I await and await and await for claims data. There it is, Michael.
Okay, you want to know something weird, Tom? This is the third week in a row that jobless claims, the initial print has come in at 229,000. Last month, it was revised up a little higher. The expectation was for 226, but basically, we've entered a sort of period of stasis, it appears, with jobless claims. They're at about the same level. A lot of people have been wondering, are they going to be the canary in the coal mine and start raising recession concerns? And you would expect that because basically, if you look back in history at recessions, jobless claims do rise going into recessions. Now, they rise at other times and don't predict recessions, but they do definitely rise into recessions. So if we're kind of flat at this point, it doesn't look like anything's imminent, which is, of course, is what Jay Powell said yesterday. Nothing's imminent.
Claims are symmetric. You have been a genius, Michael McKee, on the JOLT survey as well. If you were sitting with Chairman Powell, what would you say about these other surveys? Do they show his strong economy as well, JOLTS and the others that you lean on?
Well, they do show a very strong labor economy, and that's what the Fed has been talking about. The JOLTS obviously suggest that there are an awful lot of job openings that are unfilled, and therefore, if you lose a job, you could probably easily find another. Of course, there's a composition effect there, but there's just so many open jobs. The question is, do companies start paring back on their hiring plans and stop posting job openings because they think there's going to be a recession? And it's hard with JOLTS to know, Tom, because those are delayed by 2 months. So it's old data.
Delayed as well was a revision. Lisa, we got it out. McKee almost fell off his chair here, seeing it peripherally. 231,000, a shock from 229 out to 231.
Yeah, really shocking numbers. Look, they gave it a little bit, and the emphasis on a little bit weaker, and we're getting a little bit of a reaction in markets. If you want to just basically, I mean, it's a CFA talk that I learned from you, Tom. We're looking right now at a little bit of retracement of some of the gains from earlier in the day. The NASDAQ futures now just up about 5 to 6/10%, and the S&P up 0.4%. Meanwhile, the 2-year getting a bit of a bid, well under 3%. But how much are these numbers really going to reflect the true softening, Tom, that we're seeing in markets with job openings just simply being taken off the market and things that people say are the stealth softening of the U.S. labor market?
We'll have to see on that. Mike McKee, very quickly here to get into Andrew Hollenhorst. How important to you is the 5-year look forward from 5 years out, the 5-10 inflation expectations at the University of Michigan tomorrow?
Oh, it's going to be very important, not because people are accurate in their predictions about inflation, but because it will inform their expectations, and that is what drives the Fed. That's why Jay Powell said we went to 75 last month.
Let's go right there now with Andrew Hollenhorst, chief U.S. economist, Citibank, of course, with an important call for a much higher rate and terminal value and all the other mathematical mumbo-jumbo. Andrew, I want to go to 10 a.m. tomorrow morning, which you and I agree, and Michael McKee agrees, I think all agree. Inflation expectations are important. They have spiked up. Are we unanchored in our expectations?
Yeah, critically important, Tom. I think that was kind of the last data point that the Fed could still point to and say there was some notion that we weren't on a more inflationary journey. And as that University of Michigan 5 to 10 year expectation lifts above 3%, and we'll see where it comes in tomorrow, that just increases the concern that there really is an embedded sense to this inflation. I think we already saw it in the labor market, like you were just talking about, where we have wage growth that by various different measures, 4 to 6% wage growth. Chair Powell was talking about that yesterday. And then you have price growth that is, 6% plus, depending on the measure that you look at. So I think there's a notion of a wage price spiral here. I think a little bit of what we're seeing at University of Michigan is confirming that also. Just like Mike McKee was saying, it's not that the 5 to 10 year expectation is the correct expectation, but it just tells you something about how inflation is becoming a structural factor in the economy.
Yeah, but just as quickly as people get used to that, Andrew, how much is the labor market shifting already? And we're not necessarily seeing that in claims going up, although, they ticked up a little bit, but really it's not that significant. How much are we seeing just job listings being taken down or not filled, or companies paring back some of their business ambitions?
Yeah, I think that's what's difficult here is, as an economist, you're always looking at two things. You're looking at the level of activity and the level of strength, but then you're also looking at the direction of travel. And really what you want to get right is the direction of travel, because that's going to determine where you're going. And we know a lot of things are very strong. We know the labor market has been very strong, continues to be very strong, lots of job openings, relatively few unemployed individuals. But that kind of leading edge of the direction of travel, the weekly initial jobless claims data, that's giving me a lot more of a real-time signal of the labor market than something like job openings, which has lagged a couple months. So if you look at those initial claims, again, the level's still very low. Hard to think that it's a difficult time to find a job in most sectors, at least, because the vacancies are so high. So it's not so much of a concern about the labor market being soft today. Everybody would agree it's strong today. But I'm watching those claims. I think that what we're seeing now is, kind of some seasonal noise, nothing to get too concerned about. But it's definitely the case if you bring economists like me back on the show a month from now, 2 months from now, and we've seen these initial jobless claims that have continued to trend up, we'll have a lot more pessimistic view.
Well, Tom has done a really good job today, not just talking about the domestic labor market, but looking internationally and what the ramifications from some of the global downdraft has been. And that has been in the stronger dollar. And in addition to jobless claims, we also got the current account balance out for the United States, which surprised to the downside. We have a record trade deficit once again, as the strong dollar allows the U.S. to import more goods. How does this factor into your view on the GDP level, considering the prowess of the dollar and the ongoing sort of disinflationary object of that, but not the money coming back into the U.S. economy?
Yeah, so the trade balance has really been kind of swinging around wildly, which is kind of a combination of the post-COVID reopening phase of the economy as trade kind of got more fully restarted as the economies reopened globally, and then this kind of pattern of, well, you had renewed waves of COVID, which are disrupting goods, and then you have supply chain issues, right, which on top of that. So I'm really being very careful with that trade data right now in terms of interpreting it as any kind of longer term trend and where the economy is going. If I look at the effect of the stronger dollar, I think one thing that's maybe surprising, maybe even a little bit surprising to me and how this has played out, like Tom was saying, we have revised up our terminal Fed funds policy rate forecast to above 4% now. Wow. And getting there in the first quarter of 2023. So, we're really getting rates to quite high levels in the U.S. That's not an out there view anymore. The market has been pricing something not too far off from that when we were at higher yield levels. And the dollar, yes, has strengthened. But, if you had just told me 6 months ago, we're all going to kind of think that Fed funds effective is getting above 3.5%. Where's the U.S. dollar? I would have thought a lot stronger than where it is now. So I think relative to that counterfactual, it's maybe not as much of a slowing factor for the economy.
Andrew, I mentioned this earlier in the show, but when Powell was testifying on Capitol Hill yesterday and Elizabeth Warren was asking him if a rate hike would solve higher grocery prices or higher prices at the pump, his answer obviously was no. The Fed isn't equipped to deal with some of those more supply-side driven challenges. What is your confidence that the Fed actually can get demand down enough to the extent that it actually will offset persistent tight supply?
Yeah, it's a really important question. And, those questions that Chair Powell was answering yesterday and, again today just show how difficult this moment is for monetary policy and for policymakers. When there's a supply side constraint and it's persistent, the only thing you can do is damp demand to try to bring the economy back into equilibrium and bring inflationary pressure down. I'm very confident, to answer your question, that the Fed will be able to slow demand sufficiently to bring demand down. The issue is, how much slowing is that going to be? How much of an output gap does the Fed need to create? How much weakness in the labor market? If you look at the Fed summary of economic projections, they have the unemployment rate that just moves up by a few tenths of a percentage point. So if you keep moving interest rates higher, if you keep tightening financial conditions, it will slow down the economy. The real issue for the Fed is not whether or not they can slow it down. It's, can they slow it down and have it be a relative moderate slowdown and still get inflationary pressure down?
Andrew, thank you so much. Andrew Hollenhorst with Citigroup here with that shocking terminal rate statistic above 4%. I'm going to call that on the edge of outlier on Wall Street. Lisa?
Yeah, well, on the edge of outlier, akin to Deutsche Bank, that no longer is such an outlier, as you're seeing that priced in the Fed funds futures. We're going to be discussing this as well as a host of other market issues. Samir Samana, Senior Global Market Strategist over at Wells Fargo's Institute. We're going to be speaking with her on the open. But we are watching, and Tom, you've been talking about this all morning. I do think it's really important. Maria Tadeo sitting down with the president of Lithuania as we look ahead to some sort of tension continuing to rise in Eastern Europe, Tom.
It's going to be fascinating as well. To help you with the geography, folks, from Vilnius over by Belarus, you go west on a road to Kaliningrad, which is Russian territory surrounded by Lithuania in Poland. It is hypersensitive to all Russians, and particularly to Mr. Putin with his St. Petersburg heritage. These have all sorts of, Lisa, third rail attributes for Russia.
And how do we deal with this situation where any escalation draws in NATO, right? Where is that line for Russia? Where do they not want to poke the bear? Or are they getting bolder as they make more headway in the eastern part of Ukraine? I mean, these are things that we wish we were not talking about. Yet the tragedies do continue, as you talked about earlier, with some of the fighting, Tom, that we're seeing. And we hope that there is some resolution.
Well, we'll have to see on the resolution. There's fierce fighting in eastern Ukraine. Lisa?
Yeah, right now we are seeing the rally fade just a touch with the S&P up about 0.4%. The NASDAQ up less than 0.6%. Yields still lower and actually heading south of 3% on that 2-year yield. From New York City, this is Bloomberg.
Keeping you up to date with news from around the world with the First Word, I'm Ritika Gupta. Both Republicans and Democrats in Congress are signaling there is little support for President Biden's call to suspend the federal gasoline tax. It's seen as a symbolic move by a president running out of options to ease prices at the pump. The president blames much of the increase on Russia's invasion of Ukraine. Germany has triggered the second stage of its natural gas emergency plan as Russia cuts back supplies. That has European gas prices rising. In the so-called alarm phase, Berlin will tighten monitoring of the gas market and reactivate some coal-fired plants. The German government warned this week that there could be further cutbacks in Russian gas. U.S. prosecutors say British socialite Ghislaine Maxwell should spend 30 to 55 years in prison for engaging in a sex trafficking scheme with the late Jeffrey Epstein. A federal judge will sentence Maxwell next week. Prosecutors called Maxwell a sophisticated predator. Bloomberg's learned that Tesla is taking steps to ramp up output at its factory in Shanghai. The electric vehicle maker will partly suspend manufacturing at various points through early August so it can upgrade production lines. The goal is to eventually double its original planned target to 1 million cars a year. And in sports, the 30 teams in the National Basketball Association will be hoping to find the next Steph Curry tonight in the annual NBA draft. U.S. colleges have provided the bulk of the league's players for decades. But now teams are also looking at Africa, where the NBA started a league in hopes of developing a new generation of stars. Orlando has the top pick in this year's draft. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Companies now, they're getting hundreds, maybe even thousands of applications. So software has come in to automate the process.
You want to write your resume for robots, not for humans. The only job your resume has is to be comprehensible to the software that is reading it, because that software or robot is going to decide whether or not a human ever gets their eyes on it.
These things are programmed by a certain segment of the population that might not be totally inclusive or not be fully aware.
Concerns about how this technology could exacerbate discrimination. For the FTC, I think foremost, the FTC needs to be making sure that we're fully understanding this technology.
We don't trust companies to self-regulate when it comes to pollution. We don't trust them to self-regulate when it comes to workplace comp. Why on earth would we trust them to self-regulate AI?
Wherever you get your news.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg. Lots happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
It's a great question.
Great question.
Great question.
Great question.
Great question.
That's going to be the best question I get all night.
I'm glad you asked that.
Bloomberg Television. Top experts. Great questions.
Bloomberg Surveillance, we say good morning to all of you. Kaylee Lyons and Tom Keene in New York. Our Maria Tadeo in Brussels. And now, as the Baltic states consider Ukraine as they consider Russia, a conversation with the president of Lithuania. Maria, good morning.
Thanks, Tom. And let's go straight, of course, with the president of Lithuania, Mr. Nausėda. From day one, you've said Russia is a threat to European security. Ukraine has to win, and we need to see NATO troops deployed in big numbers on the eastern flank. But I want to ask you about a very delicate situation for you, so I appreciate you taking the time today on Kaliningrad. When you look at it on a map, it's between your country, Lithuania, Poland, but it belongs to the Russian Federation, and the Russian Federation now openly accuses you, your country, of blocking transport from the Russian Federation to Kaliningrad. They say there could be real repercussions. Are you concerned?
We got used to that kind of manipulation, disinformation, and threatening. It comes very often. And we got used to have this very dangerous neighbor very near to us. And this is nothing special. I just want to say that this issue we are talking, this is not bilateral issue between Lithuania and Russia. I would like to remind you that in March, the European Council decided on the fourth package of sanctions, which include some ferrous metals, iron, steel, and also some luxury goods. And what is Lithuania is doing? Lithuania is just implementing those sanctions according to the rules and prescriptions of European Commission. Now we are in the situation where we have to apply those sanctions imposed, And this creates, of course, some tension between Lithuania and Russia. But I think that Russia is just acting disproportionately. And they are trying to use this opportunity just to blow the propaganda bubble. I would name this like this.
But when you say it's a propaganda bubble, what specifically? Because the Russians, what they say is that you're preventing the Russian Federation from supplying a territory of the Russian Federation, that is Kaliningrad. What's the propaganda that Vladimir Putin is trying to put out?
No blockade if we are talking about passengers.
Because that could mean a belligerent
no.
action. A blockade could be seen by Russia as belligerent.
It's not blockade because if we are talking about non-sanctioned goods, we are talking about passengers, there is no blockade. There is absolutely free movement between the territory of Russian mainland and Kaliningrad region through the territory of Lithuania. Now we are talking about this concrete group, and of course we need precise setting of just specific features and reglement how we can apply this fourth package of sanctions, and we are waiting for European Commission's explanation.
To give that guidance. I wonder, ever since the war started, is Vladimir Putin always on your mind? The idea that for Lithuania, the Baltics, this is almost an existential threat, potentially, too.
No, we are concentrated on our economic progress, prosperity of our people, and, you know, we don't have the time to think all the time about Vladimir Putin. Of course, we understand that situation in the eastern part of Europe is really dangerous, and we strongly condemned this war against Ukraine. We are a very keen supporter of Ukraine, trying to help to assist them by all means, by military means, economically, humanitarian means, and of course political component is very important too. So this is the reason why Lithuania is very enthusiastic supporter of granting candidate status to Ukraine, and I hope very much, and I am looking forward that it will happen this evening.
And of course, you've said Ukraine has to win because it's the right thing, but if it doesn't and it gets defeated by Russia, the repercussions of that could be enormous for the rest of Europe. What do you mean by that, and what does victory of Ukraine mean for you?
The victory of Ukraine means a victory of just historic truth, because they are fighting for their freedom, for the right of the country, of the people of the country, to decide about the future, about their destiny, and nobody else, and especially external forces, cannot decide where Ukraine have to do, what Ukraine have to do, and where we should go. Ukraine is, according to, I am fully convinced that Ukraine is European nation, because they prove every day by fighting against the aggressor that they defend European values, they defend democratic values, and so they are fighting not only for their freedom, they are fighting for our freedom, for the freedom of European Union too.
And sir, next week there's the NATO meeting. Of course, President Biden will be there. The Baltics, your country, you've said we need more troops here stationed. The eastern flank needs to be a priority. This is not just about China. Russia's an equal threat. What are you going to tell the President of the United States?
This is very important to have very adequate evaluation of the situation, what is happening in the eastern flank of NATO. And we see the security issue is becoming more and more important. The threats are materializing very fast.
It's a new Cold War.
I don't want to talk about some threats which are theoretical, but first of all, we have to spend much more attention to the security of eastern flank in order to make deterrence factors as most effective as it is possible. And this is very important, not to show our willingness in case of aggression, but to show that we are ready to increase the number of troops, to increase military equipment in our countries. And of course, very important is to switch to the current air policing regime in Baltic countries, to air defense regime. It is very important too. And I am looking forward that conclusion text of NATO will be suitable to cooperate, to work with the leading country of our EFP troops in Lithuania, namely Germany. I signed a communique with the German Chancellor Olaf Scholz 2 weeks ago, and according to this communique, Germany is committed to send additional troops up to brigade level, so the scale up for military presence in Lithuania. And I think this is very important to increase or to scale up the military presence of other countries in other Baltic countries too, in Latvia and Estonia namely.
Well, President, thank you so much for your time. We appreciate you, of course, in Bloomberg, as always, and your message is clear. Appeasement is not going to work with Russia. Thanks so much.
Very much.
Tom?
Maria, thank you so much. Maria Tadeo, in a conversation, folks, I honestly never framed in my lifetime. I never thought we would hear that kind of tone, those statements from a member of the Baltic states. Of course, balance of power drives forward the conversation, not in the Baltic states, on the Virginia state. Glenn Youngkin will join. This is Bloomberg. Good morning.
Energy prices and a short supply of key chemicals that produce synthetic fertilisers are sending pig, cow and horse manure prices soaring. Even human waste is in demand as farmers hunt for alternatives. Fertiliser helps increase crop yields.
You can see how much moisture is held into this. It's a lot of organic material into the compost, so it breaks down. The manure and the straw breaks down into a friable mix that can be mixed into your soil in the ground and for growing a whole range of different vegetables. Holds the nutrients in, holds the water in, and it really increases the kind of biodynamic profile of the soil.
The recent price spike could mean more farmers going organic for the long term.
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
I think what we've seen during this period of time is that communicating via video is not a fad, that we are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
From New York City for our viewers worldwide, I'm Lisa Abramowitz in for Jonathan Ferro. A lift to markets. Stocks indicated higher ahead of the open. Bonds getting a bid as well. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Ferro.
We begin with the big issue, forecasting the Fed's next move.
I don't think there was really anything new in Chair Powell's testimony.
It was quite hawkish.
Even a 1% move was not out of the question.
It's going to be really difficult for the Fed to hike rates aggressively.
We should get prepared for recession pressure.
More pain to come in broader markets.
Financial conditions tightening.
If the Fed remains as aggressive, I think those recession risks rise.
Becoming increasingly amplified.
They will continue to hike rates aggressively in the short run.
You will have fast rate hikes.
The fear of a recession will remain there.
They are acutely aware that there is likely to be some pain to the economy.
Joining us now to discuss is JP Morgan's Monica DeCenso and Invesco's Alessio Dolongas. Monica, let's start with you. From what we've heard, are you starting to get a more concrete sense of a hard versus a soft landing?
We still believe there's a path for this to be a soft-ish landing, but clearly recession risks have increased. We acknowledge that. I think it's important to note that the market has acknowledged that. And so that plays in a lot to how we think about positioning from here.
Alessio, you still remain overweight risk, and it seems like people are getting more gloomy on one hand, and yet they're seeing the beginning of the next cycle on the other. How do you stack up your view based on what we've heard from Fed Chair Jay Powell and the increasing use of the R word?
Yes, it's a fluid situation where we believe at this stage the probability of a soft landing is much, much higher than a hard landing. And it's really about balancing risk in the portfolio. What is the right way to balance that risk? If we are heading into a slowdown, but not a recession, we think a better way to maintain risk exposure is to be underweight credit, for example, while maintaining some upside through equity markets. Because ultimately, credit investors, as you know very well, Lisa, credit investors sell a call option, sell that upside to equity investors. So in a global 60-40 portfolio, just for a reference point, maintaining an overweight risk stance through some upside through equity, underweight credit, particularly risky credit such as high yield or bank loans, could be a way to wait for this transition to take place. The likelihood of a meaningful slowdown is going up, and we don't think it is priced in.
All right, so that seems to be a feeling and a fear that we have in markets. We caught up with former New York Fed President Bill Dudley on this issue of recession yesterday. Take a listen.
You really get a deep downturn when things in the financial system break and the ability to supply credit to people becomes impaired. I don't expect that to happen this time. So I would expect a mild recession like 1990 or 2001, not a deep recession like 73, 74, or of course the great financial crisis.
And Monica, Bill seemed to really underscore what both of you are saying, this sort of mild recession case as sort of the increasing base case. Is there anywhere that it's been overpriced, the idea of recession, or do we basically have a market, Monica, that is agreeing with you, and right now a mild recession is consensus?
I think clearly the market believes we're either in a recession or we'll be in one shortly. That's clear, right? Down 20%. But the challenge now is you look at how tight correlations have been, and you expect to start seeing more dispersion again. And I think that's the opportunity. The question remains, where do I want to get access now? Where do I see value, for example, going into year end, where there's still levers to pull in the equity market, and people are just so defensively positioned that I think that creates the opportunity in pockets like energy and even parts of healthcare to add some risk in an intelligent way, acknowledging that we're probably not at the bottom, but we feel much closer to the bottom in our view in a mild recessionary scenario.
Monica, is that largely risk in equities, or do you also see risk in credit, kind of like what Alessio was talking about?
I think Alessio is spot on. Like, you don't need to take a ton of risk and go really far out to really risky things right now. You're getting paid in core fixed income. So why wouldn't I allocate a little more there? An asset class that hasn't made sense over the last 5 to 10 years suddenly is more interesting. And I do believe going forward will provide a better balance to portfolios than it did for the first 6 months of the year.
Chair Powell weighing in on the possibility of an economic recession. Take a listen.
It's not our intended outcome at all, but it's certainly a possibility. And frankly, the events of the last few months around the world have made it more difficult for us to achieve what we want, which is 2% inflation and still a strong labor market.
We got more data. We're getting even more. Here's Bloomberg's Michael McKee with a closer look. Mike.
Well, Lisa, the question is, are we in recession now? Are we going into recession later, or can the Fed thread the needle? The data right now suggests nothing on the horizon is imminent. You take a look at existing home sales, which we got last week. They are down, and of course, that's what you'd expect when mortgage rates are going up. You can see the red line there is when the Fed first raised interest rates. But it's that blue line that we're really paying attention to here. That's jobless claims went down last week by 3,000. They've elevated a little bit, but they're still staying in roughly the same range. So it doesn't look like the labor market is weakening yet. That's the thing to keep in mind. We have a number of economic data points coming up over the next week or so that we want to keep an eye on. And these are not just the traditional ones, but these are the ones that are going to be, as that last graphic had it, the recession Rorschach. We're going to take a look at jobless claims every week. Friday, Michigan inflation expectations. That's what drove the Fed to a 75 basis point move last week. And we get an update on that tomorrow. New home prices. We know sales are weak, but our price is going to start coming down because they keep adding to inflation. On next week, on the 27th, we get the capital goods orders. Are businesses cutting back at all? Conference board expectations. This is an interesting one because it's tied to the job market much more than the Michigan numbers. So if the job market's weakening, that's what will give us a clue. And then, of course, consumer spending next week. The retail sales numbers just give us goods, basically. The spending on services will come in this report, and that will be a key number for the Fed to watch. As we watch Jay Powell today, we haven't heard a whole lot new from him. How far and how fast do rates rise? Maybe he'll give us a little more on that. How much and how quickly does the economy slow? He says they hope it doesn't slow too much. And how will the Fed know whether it's gone too far? That may be the key question left, Lisa.
Michael McKee, thank you so much. And at 10 a.m., we do get, of course, the testimony from Fed Chair Jay Powell, day 2 on Capitol Hill. Monica DeCenso and Alessio DeLongis still with us. Alessio, I want to dig in a little bit to your call about leaning into risk, and you view that largely through the equity markets, but you're also starting to lean into credit. We're talking about the R word, and we're not talking about an increase, a dramatic increase in defaults. Do you think that we have overpriced a default cycle that has basically been killed by the locking in of longer-term maturities and a Fed that will eventually step in to the rescue if there is true disruption?
No, the situation is fairly fluid. My point with the view on credit is that if you look at high quality credit where you can start to harvest 5% yields, which we haven't seen in a generation, it certainly argues for beginning to reposition for this more supportive environment for harvesting yield in the low segment, in the high quality parts of the market, primarily because you're really sourcing duration there and defensiveness. When you look at the risky parts of credit markets, I think there is more of a concern where recession risk is not priced. Like, Monica mentioned something earlier. There are several metrics that we can point to suggest that a recession is priced. But let me provide an example. Equity markets are down about 25% year to date, just in line with the underperformance of 30-year government bonds. Now, equity markets are a long-duration asset. What is that telling us? Is telling us that equities have just repriced the rise in discount yields. Equities have just derated their valuations because of tighter monetary policy. But we haven't necessarily seen the typical recessionary dislocations, be it freezing in risky credit markets, underperformance of EM overdeveloped, or small and mid caps over large caps. We are not seeing those typical recession dynamics. And to go back to your earlier question, Lisa, that's where we believe that in and of itself, a recession is not priced through the default cycle. And we don't think that the Fed is going to necessarily come in and rescue the day as we have seen in the past.
And to sort of build on this point, some people would argue that we're not really out of the low rate regime. We're just taking a pause. And Paul Krugman of the New York Times wrote a column to that effect. HSBC's Stephen Major, I'm sure, agrees. He weighed in on the peak of the U.S. rate cycle. Take a listen.
the Fed is well served by keeping some hawkishness there, because if they appear that they've reached the peak, then financial conditions will loosen and the policy won't work. So that they need a couple more months of this, and then I think that by maybe August, September, it's time for the formal shift to take place. The markets are smelling it already.
And Monica, perhaps the markets are smelling it in the rally that we're seeing across the board in U.S. government bonds, but particularly on the short end of the curve. How much do you buy into duration? How much do you buy into this idea that the Fed will basically prove to be a head fake in terms of how much they're going to hike rates?
I'm hesitant to say head fake, but I do think it's fair to assume that they're going to be nimble. They want to do the right thing and try to guide this as best they can. And so for us, observing markets, the challenge is going back to the earlier points. How much is priced in? What's the risk reward here? And if we are in a recession and they can't prevent that, how much more weakness is there to come? And again, it does feel like we've priced in a large amount of it, which is why I'm comfortable taking a little bit of risk on the equity side and even, adding a little bit on fixed income again. I don't think you need to stretch, but on the core side, if you can make 4 or 5%, that feels like a no-brainer.
Well, and Alessio, do these stories go together? Is a bid into duration what's underpinning the bid into equities, because people do not believe that there's going to be runaway inflation and a bond bear market that continues to experience pain?
It is sort of the right compromise. When you look at what is priced in for Q1 of next year, the Fed funds is priced in at 3.5. Obviously, we have experienced that kind of rapid move thus far, and we've been proven wrong. So it's certainly possible. But if you believe that the economy is slowing, beginning to lengthen duration and or add more to higher quality fixed income relative to risky fixed income or equities, it is possible. And the way to make it consistent is, for example, to begin to move into defensive equity sectors and defensive equity factors such as quality over value or large over size. What we have seen year to date has been an outperformance of cyclical sectors, ironically enough, because they've been lifted by the rise in discount yield. So the pricing of the typical cycle this time around has not worked out, because markets have been predominantly driven by a repricing of yields rather than a repricing of cash flows. So to Monica's point, if the economy is soft landing and not going into a recession, you can be both overweight equities and overweight duration. That is sort of where this can work out, assuming we avoid a recession.
Revenge of the 60-40. Monica DeCenso and Alessio DeLongis, both of you sticking with us. Joining us now with a look at the stocks moving ahead of the opening bell. Here's Abigail Dullo.
Well, Lisa, we're certainly looking at a firmer open for stocks. The S&P 500 E-mini futures off the highs, but up about 0.5%. This means that big tech is higher. In fact, if you take a look at the NASDAQ 100 futures, up even more. Apple up about 1%, heading to a third out of fourth days. This is yields are in. And even though that could be a haven bid, it of course takes valuation pressures off of the big tech and the growthier names. Amazon heading to a fourth up day in a row. The first time we'll have seen that in about a month if it holds to the close. We know anything is possible. Alibaba really outperforming, up 4% on the hopes that the Ant Financial Group will go public relatively soon. Plus tailwinds over there overall with the Hong Kong HSI doing pretty well. And then Occidental Petroleum, oil may be down a little bit, but Occidental Petroleum up about 3%. This on the news that Warren Buffett's Berkshire Hathaway has added another 9.6 million shares. Investors seem to like it. Again, Occidental Petroleum strong, up 3%, Lisa.
Abigail, thank you so much. Coming up, President Biden asking Congress to help with gasoline prices.
By suspending the 18-cent gas tax, federal gas tax, for the next 90 days, we can bring down the price of gas and give families just a little bit of relief.
That conversation coming up next. What we're seeing in the markets is a rally that is building as we head toward the open, about 17 minutes away. The S&P up 0.6%. This is Bloomberg.
The Indian city of Jamnagar is a money-making machine for Asia's richest man, Mukesh Ambani. His company Reliance has the world's biggest oil refinery complex here in the city. Jamnagar is also where Ambani is making his newest bet, a $10 billion investment in green energy. His ambition is closely aligned with the Indian government's plan to reach net zero emissions by 2070. But Ambani is not alone. India's second richest man, Gautam Adani, has committed $20 billion of investment over the next decade. But India's massive dependencies on fossil fuels have some environmental advocates questioning the realism and sincerity of those green ambitions and those of its two biggest billionaires.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month and all year long.
There's really not anything that we can do about oil prices. There's a little, food prices is a bit more mixed, but for oil prices, they're set at the global level. It has to do with global oil prices and also the refining spread. Neither of these are things that we have the tools to affect.
With the Fed offering little help and perhaps having little power to do anything to address the real issues, President Biden turning to Congress calling for a suspension of the federal gas tax.
By suspending the 18-cent gas tax, federal gas tax, for the next 90 days, we can bring down the price of gas and give families just a little bit of relief. I call on the companies to pass this along, every penny of this 18 cents reduction to the consumers. There's no time now for profiteering.
Bloomberg's Anne-Marie Hordern joins us more from D.C. Anne-Marie, this was widely panned before it even came out. Was the reception different than what it was before he gave that speech?
Not really. We did hear from Speaker Pelosi out with a statement, and she said we're going to see where consensus lies on the gasoline tax pause. So, Lisa, that says to me that even Speaker Pelosi is still quite concerned and has some questions regarding what a gas tax holiday would actually achieve, because she's going to see where consensus lies. She's not even saying she's willing to bring it to a vote. She's just going to have a conversation about it. But today we should hear more about potentially any sort of dialogue moving forward between the industry and the administration when Energy Secretary Granholm will be sitting down with some of those executives that President Biden sent that letter to. But you heard it here from the State Department's senior advisor on energy security, Amos Hochstein. He says that he has been in talks with the industry, and there's nothing they need in terms of U.S. policy. What they do need is, in his terms, are bankers in New York and investors to tell them to use this money that they're making from record profits, where the price of oil is trading right now, and invest it back to production and refineries.
Anne-Marie, of course, that will take time, which is one of the key concerns for some looking at the tightness in the oil market. Anne-Marie Hordern in Washington, D.C., thank you so much. Still with us, Monica DeCenso and Alessio DeLongis. And Monica, from your perspective, looking at oil and the wild ride that it's been on over the past 48 hours, do you think people are starting to understand that perhaps there will be less demand than they previously expected because of demand destruction in the face of $5 a gallon?
It seems very clear that's what's been happening, less that there's been some quick fix to the structural issues that caused energy prices to rise in the first place. The biggest risk to our bullish view on energy and on commodities in general is real demand destruction from the deeper recession. Still, though, in a mild recessionary scenario, I think you're still looking at a world where energy prices are elevated, and I think that's the struggle that you're hearing about, from the president, that there's not an easy way to solve this near term.
And that bear case was really represented by Citigroup's Ed Morris, expecting crude prices to eventually make their way back down into the 80s, writing, quote, given the strong headwinds to growth resulting from both higher prices of commodities and central bank actions, we project a trend line downward in prices through 2023, and in all likelihood, beyond. Alessio, where do you stand on this, considering it is a contrarian view? It doesn't necessarily take into account the tightness that some people are saying, and his view is that we are overestimating demand. Do you agree?
What they're basically calling for is a return to the old relationships where growth and demand dominate supply considerations in the setting of prices of commodities. And I think it's perfectly consistent with what the Fed is trying to achieve, right? So on the margin, I tend to agree with that view and the rationale for that view. The timing obviously may be off, but the rationale makes perfect sense. If on the margin, the news flow on the supply side bearing major exogenous shocks, that news flow is receding. And the real news flow now is on the demand side, where the Fed has taken control of the rate of change. So rising inventories and an oil curve that goes back into contango is what you want to see as a proof that that mechanism is taking place.
Alessio, have you started to fade energy stocks in the face of the potential for this demand destruction?
Yes, the move, the positioning that would be consistent with that is something along the lines of what we discussed earlier, right? A rotation out of cyclicals into defensive, so out of energy, industrials, materials, out of value sectors into quality-oriented sectors, which also would mean communication services and technology, right? If yields peak here, and now the innovation is on this re-rating down of cash flows, cash flow growth expectations coming down, that's the rotation from value to quality or from cyclical sectors into defensive sectors.
Monica, what about you? Have you also started to reduce your allocation to energy? I know you are overweight energy, or do like that space because of this idea that of a soft landing and not necessarily the depth of the recession that is the bear case.
I think generally speaking, you want to be more cautious on cyclicals going into a recessionary time, clearly. That said, even at $80, $90 a barrel, there's still a lot of energy names, especially on the U.S. side, that could work going into next year. And so that's where we're sort of threading the needle on the energy call, that we still see upside for plenty of these names in the U.S., and that's fine, but that doesn't mean you have to be overweight cyclicals in general. Broadly speaking, clearly want to be more defensively positioned, but there's pockets, oil field services, other parts of energy that probably still work.
So Monica, are you buying into the weakness that we've seen in oil majors over the past couple of trading sessions?
We have seen actually profit taking in recent weeks, but if this dip were to continue, we see another 5 to 10% lower, absolutely. That said, you've seen positioning. I think people have been bullish, but bear in mind, allocations overall to the energy sector are still very low versus where they used to be because of the destruction of wealth that happened over the last 10 years because of the end of that commodity super cycle.
My thanks to Alessio DeLongis for being with us today. Monica DeCenso, you're sticking with us. Coming up, the morning calls and later recession fears dominating markets. We'll discuss with Samir Samana of Wells Fargo. That conversation still ahead. We are trying to retrace some of the losses of last week. The S&P building into the open, up 0.7%. From New York, this is Bloomberg.
The Delhi airport, and behind me you can see SpiceJet 737 MAX aircraft. SpiceJet Chairman Ajay Singh earlier today said that Boeing is going to compensate SpiceJet in form of cash and aircraft. Celebration as you can see, they've literally rolled down the red carpet for SpiceJet Chairman Ajay Singh. There are balloons, there are flowers. This is a big deal for SpiceJet because it is the only Indian operator of Boeing 737 MAX planes currently.
In crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
This is Countdown to the Open. I'm Lisa Abramowitz in for Jonathan Farrow, taking a quick look at the rally that is building ahead of the Open as we see NASDAQ futures up about 1%, S&P up 0.7%. That bid into bonds perhaps underpinning of it. Across of the yield spectrum, we can see 10-year yields now almost down to 3.07%. How much do we get a continued bid as people say perhaps the Fed will not be able to go as quickly as they are talking it up? Time now for our morning calls. We'll look at some of the analyst recommendations on Wall Street this morning. First up, JP Morgan upgrading Funko to overweight, seeing upside to consensus estimates with toy companies showing resilience during recessions. Next up, Raymond James upgrading Southwest Airlines to a strong buy, pointing to an attractive valuation following recent declines. And finally, Morgan Stanley resuming coverage on eBay with a street low $36 price target, expecting market share losses to drive weaker top-line results. Coming up, futures pointing to a rebound with stocks looking to snap their 3-week losing streak. That conversation coming up next with Samir Samana of Wells Fargo. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
This This is Countdown to the Open. I'm Lisa Abramowitz in for Jonathan Farrow, moments away from the start of trading, and we do see that rally as we see the NASDAQ up 0.9%, the S&P at 3784. The bid into bonds getting my attention, even as you have a Federal Reserve Chair on Capitol Hill talking about how a recession is not out of the picture. You see yields lower, bonds prices up 3.07% on the 10-year. Crude getting a little bit of a lift after having earlier been down on recession fears. Dollar strength coming through with 105 on the euro-dollar cross. Joining us now with a look at the stocks moving at the opening bell, here's Abigail Doolittle. Abby.
Well, Lisa, certainly a bullish tone here on the open, and one stock that's outperforming, participating, Occidental Petroleum, not so much because of oil, but because of Berkshire Hathaway. Warren Buffett's firm is adding to its stake, 9.6 million shares. They're the top holder of the company, owning about 17% of Occidental Petroleum. KB Home really bucking the bearish trend that we've been hearing about recently in housing, up 5.2%. This after they put up a solid beat and they raised the outlook slightly. Darden Restaurants had been higher earlier. It's still up a little bit, up about 0.5%, but they put up a good quarter. A modest beat does ease some inflation fears, both in terms of how the company handled it and diners dining out. And then finally, Lisa, we do again have mainly a bullish tone this morning, but the commodity complex is slumping for a second time. Freeport-McMoRan down about 5% over the last 2 days. Right now down about more than 2%. This, of course, as copper is slumping over the last 2 days. Another tell on the global economy and perhaps fears around a recession.
Abigail, thank you so much.
Connection lost.
San Francisco, where Bloomberg's Ed Ludlow joins us for a look at how big tech is trading at the opening bell. Ed.
Yeah, good morning, Lisa. We're up on the NASDAQ 100, a percentage point. Look at names like Apple really pushing the index higher. Apple up more than 1.3%, taking its crown back as the world's most valuable company from Saudi Aramco. Of course, Saudi Aramco being weighed on by the moves in oil in recent days, those two sectors kind of moving in opposite directions. You'll see Microsoft a big gainer. Robinhood rebounding big time, up 6.8%. There was news yesterday that Binance, a big rival, would start offering fee-free trades, which weighed on some of its platform peers. And you'll see Alibaba up around 5 percentage points. This story that policy support in China is growing. PBOC giving Ant Group, for example, potential approval to become a financial holding company, supportive of that sector. You look at this chart on the Bloomberg terminal, and we ask the question every single day at the moment, has tech bottomed out? I'm looking at a number of things. You look at NASDAQ 100 E-mini futures for September, up in 3 of the last 4 days. You look at the number of names on the S&P 500 information technology sector index that are trading above their 200-day moving average, very small. And I know you've had this conversation last week, right, with Scott Minerd of Guggenheim. You hear Mark Mobius adding to this call that he's looking at Bitcoin as kind of a leading indicator for risk assets. If we see a bottom in Bitcoin, will we see a bottom in the equity markets? That's one space we're looking at. The other conversation we're having is a global one. On the closing bell yesterday, we were talking about the Fed exporting inflation and the psychology around the technology sector globally. Differences in markets. You look at the Hang Seng, China, a really good month. The S&P 500 in the tech sector still having a bad month in the month of June, and the Stock 600 in Europe down even further. There's no consistency across tech globally, and you do wonder how big that yield story and how big that rate story will continue to be for this sector.
And I'm glad that you mentioned that. Ed Ludlow, thank you so much. How much is big tech ultimately a rate story and a proxy on whether yields are going down or up? Now turning to the banks, the Federal Reserve releasing its bank stress test results later today. Joining us now, Sonali Basak. Sonali.
You have really interesting scenarios this year, Lisa. You do have commodity shocks being priced in this year, as well as public equity and RMBS shocks. And you are already seeing some of that, obviously. Another thing the Fed will be looking for the banks is counterparty risks. What would happen if their largest counterparty had failed? Again, some of these risks we got dangerously close to in a lot of different ways in the last year or so. But when it comes to the scenarios themselves and whether the banks actually pass, the question, of course, coming out at the end of the scenario testing is the buyback and dividend plan. You have the capital return plan. The banks expected, the large five, expected to give about $80 billion back to shareholders. JP Morgan being the largest, of course, expected to come in with the most, $18.9 billion worth of buybacks and dividends, according to estimates of Bloomberg and Barclays. Bank of America and Wells Fargo, each with more than $15 billion. I must also say, though, a lot of these banks have also guided that the macro environment is getting tougher However, they are going to be taking a moderated approach to buybacks. You heard that from the likes of Citigroup, and it's also from Goldman Sachs, for example, where John Waldron just recently told investors that they were making such a good return on equity in their business that they would prefer to use capital in that fashion. So the numbers compared to what investors expect will be very interesting to watch this time around, given volatility is still soaring and given the banks will want to put money to work in that fashion, as well as lending in this tough environment as well, Lisa.
Shnalia Bossack, thank you so much. Samir Smana of Wells Fargo Investment Institute joins us now alongside JP Morgan's Monica DeCenso is still with us. Samir, I'd love to get your view actually starting on the banks because they've been so beaten up. Originally, people thought that they would benefit as rates rose. Now the concern is they're going to really suffer in the face of a slowdown in lending if there is some sort of recession. What's your view?
Yeah, I mean, look, it's all about the curve, right? I mean, if the Fed's going to treat 75 as the new 25, that curve's going to flatten pretty quickly. And it's probably only a matter of time before it inverts. That's probably a second half of 2022 story. So, we recently downgraded financials. We played them when the curve was steepening, but, with the curve flattening as fast as it is, we want to be neutral on financials. They are still cheap, especially those bigger banks, but we just see better opportunities in areas like energy, healthcare, and technology.
Monica, what about you?
Yep. As I mentioned earlier, I think you still need to question cyclicals in general. You want to be a little more cautious there going into a slower economy. And the comment, as I mentioned earlier, energy, still like pockets there. Healthcare, I think, is really interesting because we're going into an election cycle. And for the first time in many cycles, there's not as much concern about regulatory reform. And that could be an opportunity in that space.
Samir, on a broader level, we're looking at a changing market where suddenly people are talking about the R word a lot more. You also have a base case as a soft recession or a shallow recession. Are we already there?
So, that was a call we put out a few weeks ago, and, we were out of consensus then. The consensus is quickly moving towards us, and unfortunately, the way we're seeing the data evolve, we're now considering, at what point it's maybe a longer and deeper recession. So, yeah, I mean, it's probably coming in the second half, a shallow recession. Again, the question will be the duration and the magnitude. The right way for investors to position is by pulling back on risk. Even here, we're not that far off the all-time highs. I appreciate that we've had a little bit of a bear market, but we had quite the overshoot. So we have been pulling back on, more cyclical areas like small caps, emerging markets. I mentioned financials, industrials, comp services, discretionary. It's still not too late to try and get, your position for kind of wealth preservation, for the second half.
What the interesting thing is, Samir, and this is something that Goldman Sachs' Jan Hatzius has put out, talking about how recession is more front-loaded, increasingly concerned the Fed will feel compelled to respond forcefully to high headline inflation and consumer inflation expectations if energy prices rise further, even if activity slows sharply. Samir, could we get a quicker turnaround? I mean, how do you position? I know this is maybe premature, but the next edge of the cycle and getting in on consumer cyclicals or things that are more sensitive to a new economic cycle.
I think you got to be very careful with that. I mean, again, I think the Fed's got to acknowledge their role in causing inflation in the first place, which is they went kind of gangbusters with respect to fighting the downturn, both with rate cuts, buying assets, then we had fiscal stimulus kind of on top of that. So I think even if there was a recession, if they're still fighting inflation, I think the Fed's going to be very reticent to have big rate cuts. And then I think they have to acknowledge that, look, if they do, try to do too much to soften the next economic recession, that inflation could come back faster than they expect. And, that's kind of what we felt, fought in the 70s and 80s is you just kept having higher and higher lows and higher highs in inflation until the Fed finally got real.
Well, certainly the market is treating the recession risk as real. The S&P down 21% this year. The last time the index saw such drop was in the first half of 1970s. That was the first time we saw the first half suffer this much. Let's bring in Taylor Riggs for more. Taylor.
Yeah, Lisa, and really putting that into perspective, and I think what's interesting, Deutsche Bank, I think 2 days ago, had a great note out on this, that this really is one of the more painful starts to a year. We still have about one more week or so until we get to the first half, but so far, barring a huge, massive reversal, This is really going to be one of the worst starts that we've had, particularly when you adjust for inflation. And typically, as we know, stocks have sort of been the bellwether to keep up with inflation. And this time that really hasn't played out. I think what is interesting, and we always try to be forward looking on this program, that after some massive declines in the first half, historically, what happens in the second half? Do you get a total washout and you get a little bit of a rebound? Interestingly, you can. After some of these previous years, and we've looked at when the S&P has lost at least 7% or more in the first half. After that, like the 70s, as you can see there, a little bit in 82, and then of course in 2010, after a big washout in 08 and 09, equities have performed pretty well in the second half of the year. I think what is sort of maybe different this time around, though this sounds eerily similar to maybe 2099, is it really has been those big tech stocks, Lisa, right? Because this hasn't really been an equity washout. It has been a refocus on higher yields and what a higher discount rate means for present value. Well, one way we can show this, if you will, and feel free to jump in here, Lisa, is the equal weight's the big outperformer. Growth is the massive underperformer relative to value. That really shows the yield story.
Taylor Riggs, thank you so much. The returns that we've seen, highly negative. Monica DeCenso and Samir Samana both still with us. Monica, how much of margin compressions have we been pricing in, and how much of a downside surprise could we be vulnerable to as the second quarter earnings start trickling out?
I think it's pretty widely viewed that second quarter earnings won't be great. And I think that's reflected to a fair amount in the 20% plus drawdown we've seen. So now the question becomes, how do you think about positioning going into the back half of the year? You saw those stats of how snapbacks have looked in the past. Well, I don't think this is an 08-like recession. I do want to be cautious that I don't think this will be a COVID-like snapback either. We do think it makes sense to take risk in an appropriate way in pockets where we see possibility for outperformance. Again, thinking about areas in energy and healthcare, maybe even China if we see reopening faster than anticipated. But I just think it's too soon. You still have a few data points coming, Q2 earnings, the Fed kind of digesting more information over the summer before I think you'll start to see the data get easier. Markets are always going to bottom, though, before the data clarifies, so just bear in mind that.
Samir, I'm not trying to get you in trouble, but I've been seeing all of these studies showing that analysts of individual stocks have lagged behind the revisions that we've seen in just price dramatically this year. It's been one of the biggest differentials that we've seen going back to 2000. Do you take anything from some of these analysts' reports as gospel, or do you actually view them more as just sort of a benchmark to understand consensus?
Yeah, I mean, look, consensus is way behind, and earnings are the next shoe to drop. I mean, to your point, look, if revenues are slowing much, much faster than costs are, I mean, margins are probably still, as far as assumptions go, much too high. So we do think that's the next shoe to drop, and we think earnings for probably both 22 and 23 have to come down. And, where those earnings estimates go probably, kind of then leads back to where the market's bottom. Now, I will say, look, in the mid 3,000s, call it around 3,500 or so on the S&P, if we get there, you're getting paid to take the risk with a pretty high level of uncertainty. So at that point, maybe we start to look a little bit through, whether the earnings shoe has dropped or not. But at least here, I think that's the biggest risk to markets is that earnings, at least the biggest, downdrafts from, estimates, assumptions is still to come in the future.
Our thanks to Monica DeCenso, Samir Samana. You're sticking with us. Coming up, recession fears keeping markets on an edge.
In the U.S. case, I think it's quite likely you have a recession, given the extent of the inflation, the strength of the labor market. The Fed needs to slow the economy, needs to get unemployment up in effect.
And the latest tea leaf is incoming just a few minutes away from another piece of data. That's next from New York. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
It's almost the end of the year, but Bali is still quiet and empty. I am here in Kuta Legian, one of the main walking streets here that is used to be a tourist spot for beach, dining, shopping, but many shops here are still closed. Most of the outlets are either for rent or for sale as they have run out of business.
Saya kerjanya di sini udah lama, udah ada 10 tahunan di sini kerja. Masih sepi sih, nggak kayak dulu. Kalau dulu kan rame, sekarang ya ada 1-2 itu ada, tapi nggak kayak dulu. Kalau dulu rame sekali. Sekarang paling dapat jualan ya 100, 120 gitu, 200 ya. Kalau dulu sih ya nyampe dah 1 juta, 1,5 tuh nyampe dapat jualan. Bisa sampai 2 juta dulu. Sekarang nggak pernah lagi dapat segitu. Sama aja. Belum ada turis ke Bali. Masih ya domestik aja.
While Bali has reopened its borders for foreign tourists since October, they're still not coming in. Many international airlines are yet to reinstate their direct flight to the island. Balinese people here really hope they can see more people from Australia, China, and Europe to come visit next year.
We are all unique. Without diversity, life would be excruciatingly dull. It's something worth celebrating. It's something that makes us stronger as communities, as businesses, and as individuals.
I see the benefits at Bloomberg on a daily basis. It's beyond flying that rainbow flag. It's about taking the discussions out into the world and making a genuine difference.
This is Bloomberg Markets, The Open. We do have some data breaking on the terminal. Another downside surprise. Here is our own Michael McKee. Mike.
Yeah, it's the S&P PMIs, the Purchasing Managers Indexes. These are smaller companies than in the ISM report in general, but still representative. And they have all come in weaker than expected, significantly a downturn in manufacturing from 57 to 52.4. The services PMI falls to 51.6 from 53.4, and the composite PMI is 51.2 after 53.6. Now, this parallels what we got from Europe today, which was pretty similar declines. Nobody going into contraction territory, but we are seeing numbers like Germany on their composite falling to 51.3 from 53.7. The French are down. The Eurozone as a whole falls to 51.9 from 54.8. And in the UK, they were the winner of the day. Theirs is unchanged at 53.1. But these are all just barely the numbers that you need to see show expansion. And Lisa, it does suggest that the global economy is cooling. I would go beyond just the manufacturing and look at those services numbers. That's what everybody's going to be keeping an eye on.
Yeah, this was the sector that was supposed to be rebounding as we did reopen. Michael McKee, thank you so much. I do want to just point out that two-year yields take another leg lower, now firmly below 3%, 2.94%. We are looking at as we get some of these disappointments. And as Michael said, they do track what we saw over in Europe overnight. 10-year yields sticky. It really is a question of how far the Fed will be willing to go. Back with us, Samir Samana of Wells Fargo Investment Institute, which really goes to the question of whether we're already seeing some sort of downturn in the economy and whether this gives the Fed a reprieve. What's your view, especially given the bid into the front end?
You know, given that the Fed's kind of been cut off sides with this transitory narrative once already, it's going to be hard for them to pivot now back to the economy. So until inflation comes down, I think they're probably a little bit stuck, even if there is a slowdown and even if unemployment does start to tick back up. So, you know, that really is kind of the risk to, you know, kind of the economy and markets that we've been throwing out there, which is, look, if you have a Fed focused on inflation while things are slowing, we just haven't had that combination in a long time. And history tells you that it doesn't end well. So, that's why we are calling for a shallow recession. And, the risk, if anything, is to the downside. And we think, the way for investors to position right now is to move up in quality, move up in market cap, focus on the U.S. We have a little bit of a barbell on the sector side where we like energy, tech, and healthcare. That's because we're still kind of in the latter stages of this, economic, upswing. But eventually, if anything, we'll probably get a little bit more defensive and a little less cyclical. And it's not surprising today that your top 3 or 4 sectors are utilities, healthcare, staples, and REITs. It's a very typical defensive recessionary playbook.
And Morgan Stanley's Mike Wilson with with 2 paths out of this market, quote, the bear market will not be over until recession arrives or the risk of one is extinguished. How much, Samir, are we looking at the dollar remaining the haven bid and remaining the ongoing risk-off trade as we do get this kind of environment without the risk of recession taken off the table yet?
Yeah, I mean, look, the dollar's one of the cleanest trades out there because history tells you that it's almost always a safe haven, during downturns. And this time around, we also have rate differentials working for us as well as growth differentials working for us. So for all those different reasons, if anything, the dollar has, more kind of, boosters this time around than it has during previous downturns. And, kind of to Mike's point, I guess with respect to, until recession, is extinguished, I mean, I would say, it's not over until inflation's extinguished. So, really, again, I think that's the part we have to think differently about this time around.
So right now, when we see the dollar, it's actually losing a little bit. We are still seeing that bid into bonds. Where are you taking some risk and duration? I say risk because we saw the risk of the first half of the year in terms of what total return was. But where are you taking risk in the safer spheres of the fixed income market?
Sure. So we actually recently took the opportunity to go neutral on long-term duration. We've been most unfavorable for the last year or so as rates, kind of ticked higher. So that, I think that was a pretty good move. Just again, from the standpoint of bonds do have a role to play in portfolios, and at these yields, it does make sense to be at least neutral. We like higher quality credit. This is not the time to be extending down the credit quality curve. So we recently downgraded high yield. Again, we still think there's time to up the quality in your bond portfolio. We, from a fixed income standpoint, have mainly been playing kind of defense as opposed to offense, just because you do have rates rising. But we also took the opportunity to raise the rating on short term. Again, with those short term rates rising as quickly as they are, with 75 kind of the new 25, we think some of the income that we had been stretching into the intermediate part of the curve for, we can now get on the short term side. So we up short term, we up long term, we downgraded intermediate just because there's a little bit more opportunity on those tails of the curve.
Samir, can you just put into perspective how defensive you are right now versus, say, 3 months ago, considering that some people are starting to view the next cycle as upcoming and they're starting to invest as such?
Sure. So kind of at a high level, if we were, call it 105 to 110% of our risk budget, as recently as 3 or 4 months ago, we're now probably in the mid-90s. So it's been quite the turn. And again, a lot of it has to do with, I think there were expectations that inflation would at least level off. We were not in the camp that inflation would necessarily come back down quickly, but we at least hoped for it to level off. But the fact that it was still accelerating at the last reading, that's really what's changed in the last few months. And, the other thing that's really changed is going from, again, 50 was a real debate. And now that they've moved on to 75 after taking it off the table just months ago, just shows, how much of a, tricky spot the Fed's in.
Before we let you go, Samir, how important is tomorrow's University of Michigan sentiment survey?
Sentiment's a lagging indicator, especially consumer sentiment. We can already see that the consumer's stressed, right? I mean, they're taking out loads of debt. Their mix at retailers is all about staples and groceries as opposed to apparel and, retail. So, I mean, again, the consumer's stressed. I wouldn't focus so much on that number. I think the bigger thing is going to be, watch oil, watch commodities. If they can keep coming back down, that'll take some of the pressure off the Fed going into July.
Samir Samana, thank you so much for being with us. Coming up, the market-moving events that you need to be watching. That's next in our trading diary. In the markets, you are seeing the rally fade just a touch as we head deeper into the open here. We see the S&P now just clawing onto gains up 0.1% after that disappointing number from the PMIs, just following on to what we saw over in Europe. This is Bloomberg.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
This is Bloomberg's The Open. I'm Lisa Abramowitz in for Jonathan Farrow. That PMI report that was disappointing, really sinking a hole in markets. The NASDAQ turning negative at one point, now up at 0.2%. The S&P up 0.3%. If you look over the bond space, things going pretty wild on the 2-year, sub 2.9% at one point, as yields do continue to drop on the heels of that. 10-year yields now 3.047% if you take it out a bunch of digits, as Tom Keene would like to do. Time now for the Trading Diary, what you need to be watching this week. Chair Powell on Capitol Hill for day 2 of testimony at the top of the hour. The Fed releasing this results from its stress test at 4:30 p.m. The Department of Energy holding a meeting with oil executives today. More Fed speak from Presidents Jim Bullard and Mary Daly on Friday. And finally, new home sales and the University of Michigan Consumer Sentiment Survey to close out the week. This was Countdown to the Open. This is Bloomberg.
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
Container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
Lots happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Businessweek about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands, and it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
Look for the winning number in sari stores every day, also on TV, radio, and newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number Fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number Fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with Number Fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the street, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their $1 million peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for Number Fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, "Pepsi goons bomb